Good evening, ladies and gentlemen. This is USA Trading Frank on a very memorable day. This is 9/11, September 11, 2016. 15 years from the day that some of the, well, not some, the most tragic event I would consider it in my lifetime that happened. And we are about to embark on the advanced coaching session webinar. Session will be recorded and uploaded on the YouTube channel for ACS students so they can review it at any given time. Full disclosure, this is purely for financial education and not for any solicitation or advice, as we all know. So let's kick off. The way I'm going to present tonight's session, and we'll leave a reasonable amount of time for Q&A at the end, is threefold. First, I'm going to talk a little bit about, mention a little bit about the macroeconomic backdrop of why this particular correction is in progress, and the key word is in progress. And second, we're going to talk about the probability of the different scenarios that can take place on the technical standpoint. And thirdly, we're going to talk a little bit about the behavioral game theory aspect, which as you all know, I delve in quite a bit as to how, as humans, we react to market events and how our frailties and our emotions get in the way of, and that happens to all of us, mind you, some of us more than others, get in the way of executing powerful and very profitable trades. So saying all that, so let's start off with the macroeconomic backdrop. The actual so-called economic reason, or the market reason why the big sell-off was happened on Friday, was twofold, which I mentioned a couple of times on my private real-time Twitter feed at Clueless8RT, and I'm sure all of you, read the comments, and so I'll elaborate on them a little bit. Is the fact that we had a very sharp rise on the fixed income treasury bond deals, which caused the prices of those particular fixed income treasury bonds to drop rapidly, just like a stock. We always have to, everything, remember, every asset class works the same way. They either go up or they go down. So if bond deals are going higher, that means bond prices are going lower, just the way with the stock. If a stock price is going lower in a very rapid fashion, you're going to get panic sellers, you're going to get stops triggered, and you will get people, holders, I shouldn't just say people, who have margin, who are working on leverage, i.e. margin, having to sell out. And that's exactly what happened with the bond market on Friday in a big way. So that causes ripple effects because a significant amount of money is sitting primarily in the fixed income bond market. And when they start to sell off, institutional funds and hedge funds which are sitting in those particular arenas, or sovereign bond funds, sovereign meaning countries which run their own hedge funds, that's what they're known as, what we call sovereign funds, they are forced to sell. Now, they don't just own bonds, they own a lot of stocks in there too. So it's not a fundamental basis why a particular stock sold off 2%, or why Priceline was down, whatever it was down, the $20, whatever. I'm just, I don't remember the top of my head. All that stuff. There's no fundamental reason behind it. It is simply a function of throwing the baby out with the bathwater. Now, one of the things I want to remind people, and it sounds like a cliche, but it's true, that every single major correction in the market, every crisis is the same for different reason. Whether it be the taper tantrum back in 2015, if you remember the term, they were tapering down QE, markets fell off the boat. I mean, they just literally, got submerged back in 2015, right here. That was it. All right. Big, heavy drop. This is a weekly chart. Whether it be the fear that rates were going to rise, oil prices, collapsing, that happened in January, right there, end of January to till about February. I remember the date that the markets turned, which February 8th, multiple of 8, right there. Whether it be Brexit, right there. And now, which is, I call it the rate tantrum, the rate sick, if you want to call it. This was Brexit, this was Brexit, the rate exit. Macroeconomics and deep correlations between international economies and the U.S. cannot be explained in simple terms. It cannot be done on one webinar, but they can be explained in a simple fashion. So, I mean, just so for the basics can be explained in simple fashion. When the Federal Reserve Bank of America goes ahead and Janet Yellen or Bernanke before her does something here, it has ripple effects across the board globally. We all have a very myopic vision, very short-sighted. We'd like to think that everything that we do and everything, what our actions are, whether it be central bank actions or what our markets are doing and all that stuff, is that we're the only ones. We're not. We're very interconnected. And whether we like it or not, it's a very, very interconnected financial world. And it's going to be like that forever. Nothing's going to change it. That's just the nature of the beast. So when the Fed does something here, whether they whether they go out there and hike rates in September or in December, or whether they talk hawkish, which simply means they're talking about raising rates and going on a tightening cycle, it has repercussions and ripple effects across the world. Emerging markets, especially around the globe, some of the fastest growing markets, whether it be India, whether it be Vietnam, whether it be Bangladesh, whether it be China, I consider to be an emerging market, to be honest with you. It's not a developed market, that's for sure. Developed markets are European markets, like the Germans, like the Swiss, like the UK, England, France, Italy. These are developed markets. Even though Italy, I mean, big question mark next to it. But basically, westernized democracies are considered to be developed markets. So emerging markets are the ones which are demographically, i.e. population growth is pushing them higher. They're building. They are what we were 100 years ago. So the point is that when we raise rates, and you hear a lot of talking heads on TV, you hear a lot of pundits, with their hardcore political views on both sides, oh, the central banks are not doing this, or the central banks are very good, blah, 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 all that stuff. It really doesn't matter. Because the reality is that what we do affects globally. That in turn ricochets back to us, because if they get really hurt, then our export partners out there where we're selling into, remember, we're selling into the developed markets in a very big way. Let's not fool each other. We can go ahead and get pissed off at every international country and and all kinds of stuff. But the reality is that American business, whether it be General Electric, whether it be Microsoft, whether it be Intel, whether it be Raytheon or General Dynamics, they're all selling into those markets. That's where the money's coming from, okay? Because we can't just sell into our markets and make money. Our GDP, and follow this very carefully, our gross domestic product, which is somewhere around 16 or 17 trillion dollars, huge, okay, huge, is primarily 70% consumer driven. It's you and me going out there buying things. The consumer spending is 70% of our GDP. Our manufacturing base that we are still the leaders on the front of high tech, aerospace, heavy machinery, and all kinds of advanced technologies. That's what we're still the leaders on, okay? They are selling to the world. So if the world is getting heavily hurt for whatever reason, on an economic reason, you know, because what we're doing, then it's going to bounce back to us and we're going to get hurt. There's no question about it. People don't like to think like that, but that is the truth. So saying all that, when we raise rates here, it's not that it's high time that we raise rates. There's no question about it. And they will. The Federal Reserve will. But the reality of the situation is that if they go on a rate hike binge, in other words, let's say consecutively every meeting they raise rates a quarter of a percentage point, as some of the big so-called gurus out there in the media keep on talking about, I can assure you that unless we have a corresponding growth trajectory, in other words, economy is growing rapidly, both here and overseas, we are going to fall into a global depression. And I don't think anybody's going to like it, whether it's sitting on the 90th floor of a $30 million penthouse in Manhattan or sitting in a small house in rural Virginia. Nobody's going to like it. So the fact is that the Fed walks a very, very tight rope. All right. And I'm not saying that they are right or wrong. Okay. I'm not a Federal Reserve banker. I'm just a humble trader, you know, sitting here on the East Coast. But the average trader and the average market so-called guru out there, or what average, above average, they don't seem to understand that, or they seem to deny it. So the fact is, why does it happen? Here's a simple reason. 80% of emerging market debt is denominated in US dollars. So when the US dollar climbs higher rather quickly, because there is a direct correlation between rates and interest rates and the currency. Remember, we are still the only real developed Western country in the world which has the highest interest rate, known as yield, on government bonds. Our 10-year government bond, which rose very sharply on Friday, even though it's historically one of the lowest levels that we've seen, is at 1.67%. Now listen carefully, because this stuff is important. We have negative rates in Germany. On Friday, they actually climbed back into positive, but barely above zero. And we have negative rates in Japan. And what's happening is that a lot of that global money, when they want safety, they're sitting in our government bonds, known as treasury bonds. And that's the reason why our rates are so low. Because when you have when they're all sitting and they're flowing money into treasury bonds, U.S. treasury bonds, that's depressing the yields. It's not a factor of if treasury bonds sitting here like they were back on, let me just pull this up. Okay, we were sitting at 1.4. Let me go back a little bit just to show you guys. So here's a chart that I drawn a while ago, right? So we were sitting at 1.3%. Remember, you move the decimal point, one decimal over to the left. So it's it's not 13.32. That was back in the 70s. So when they're at 1.3%, it doesn't necessarily mean that everything is terrible with the U.S. economy. A lot of it has to do with the fact, generally lower rates mean, lower dividend treasury yields mean that there is absolutely no chance of any type of growth within an economy. There's no demand for money. That's the reason why rates are low, right? Why are interest rates higher? Because there's demand for money, so rates go higher. But in this particular case, what's happened is because of the massive QE programs around, not in the U.S. anymore, but in overseas, because we have handed over the mantle, the responsibility for quantitative easing or buying large amounts of government bonds, okay, like we were till October of 2015, if you remember. I used to post the schedule for the QE purchases, during the week and stuff, and market traders we were playing off that. On certain days, there were large purchases, so open market operations, as they call it, OMO, Federal Open Market Operations, FOMO, and those days are gone. We don't do that anymore. We're now tinkering around just with rates. So the point is that now Europe and Asia have taken over the mantle, right? You all know that. Japan's doing it. It's called Abenomics. Mario Draghi implemented the ECB QE program in a big way. I think they're buying 16 billion euros a month of bonds, suppressing rates and pushing money into the economy. Like some people like to call it, printing money. It's actually not true. It's not printing money. If it was printing money, then I wouldn't even trade. I'd just sit there and say, okay, print me some money. Just give me a couple of, give me a couple of $1,000 a day, so I don't have to work so hard for my money, pay back my loans, pay back bills. We just sit there and say, okay, So that printing money myth, in my opinion, and coming from somebody who falls in the more supply side economic point, more of the conservative fiscal economic side of the equation. I'm certainly not a liberal economist, that's for sure. It's a myth. It's not a matter of printing money. So the point is that what I'm getting at is this is a chart you can see here, a daily chart of, and treat it just like a chart, okay? Just like you look at a stock chart. You have a large macro channel, then you have a minor channel down here, and you can clearly see what's going on. If I showed you this as a stock chart, you say, okay, this thing's breaking out. It certainly is breaking out. So what's happening is on the macro front is yields are now on the rise. So if I had to make a determination from it, like I do from my charting perspective, as to where treasury bond yields are flying to, they're flying to somewhere around 2% right here. Right there. It's pattern symmetry, which we're going to talk about in a few minutes with markets. So it's a nice little pattern, a nice base. Now we broke out of this downtrend line. This big, fat, white line should be in red. And at this point, if this was a chart, this is what I'd draw. Okay, we're going to almost 2%. So the markets are nervous. They're like, hold on a minute, we're moving to 2%, but the U.S. markets are more nervous about what's going to happen in emerging markets, i.e. overseas, the places that we sell into. our goods are sold into. All right? So the developing world. So the point is that if rates rise very rapidly from this 1.67% that we closed at on Friday to 2%, let's say this happens between now and Friday, giving a hypothetical thing, it would be horrendous. We would be down 1,000 points on the market because it's not the fact that rates are rising. That's a good thing. That means there's healthy growth everywhere. So there's demand for money. So rates are rising. Money's flowing out of the fixed income safe havens, right? You guys all understand that. Money's, prices coming down on bonds. That means money's flowing out of there. They should be flowing into risk assets. Risk assets are known as stocks. Everyone following me so far?
Yeah.
Yes.
Yes.
Okay, Paras. Okay, good. So this is important because this gives us a background before we get into the technicals and some good strategies about what we can do in the days coming ahead. But I just want to show you the background a little because it's very, very important. To me, this stuff is just like, following a sports team, right? So it's just like, it's a soap opera. What's going, life is a soap opera. All right. So who was the one who once very famously said, I can't remember the quote. It said that we all like to make our lives, our lives are just a soap opera, and we'd like to make it think like that's true of everything that's happening all around. No, it's true of what's happening with us. So with markets, as long as you know who the actors are and how it develops, then it helps you better in understanding the dynamics of the market and individual stocks and stuff that we trade in. It just gives us a better feel, just like a sports team. If you know who the players are, you know who's getting, bought and, what do you call, signed up and, like I say, bought and sold between different teams, right? Moved around. You know what the probabilities are, whether that team's going to win or not. Whether it be in baseball, whether it be in football and basketball, it's all the same story. It's the same thing with the stock markets. If you know who the actors are and how they're behaving and what the variables are, then you feel a little bit more comfortable in what you're doing. It doesn't mean that we don't feel like, crap on certain days, but at least it gives you a sense of like understanding. So that's the reason why I explain these things. It's extremely important because these are things that are taught in, if you went to HBS, Harvard Business School, and paid $100,000 a year, only if you managed to get in there, okay, or you went to Dartmouth, or you went to Carnegie Mellon, or you went to what do you call UPenn or Princeton or MIT. They teach you this stuff. So I'm just giving you the basics of it. So the point is that if all of a sudden, coming back to this, if rates went really sharp, real rapid, rates rose 3.5% in one day. Not the actual rate. The actual rate was at 1.67%, but it rose 3.5% from the day before, from Thursday. That unnerved the bond market because Rosengren, the Fed governor, who is considered a dove, that means soft on rate hikes, was a little bit hawkish, that means hard. And he said, he was tough. He said, yep, rate hikes are very likely because we're feeling comfortable, which is a good thing. But the markets don't look at it like that. Okay? The markets are weird. Remember, stock markets are very, very weird places. They don't, what we think is rational in our lives is not what's rational in the stock market. That's one thing I've been trying to teach from day one. So, and 1 + 1 doesn't equal 2. So you have to think outside the box. You have to you have to really look at all the different scenarios. So the markets thought to themselves, oh my God, here's a guy who's soft on rates, meaning doesn't want to raise rates. All of a sudden he's talking about saying, no, we are raising rates. He didn't say we're raising rates in September. He just said, no, we're very close to raising rates. The market's freaked. Okay. And rates rose very quickly. So let's say, for example, that we have a major speech tomorrow. I think it comes around 10 o'clock. Lael Brainerd, lady, Fed governor, who's also, like Rosengren, a dove. That means soft on rates. What if she's really hawkish on rates tomorrow? I can assure you, we're going to drop another 300 points real fast, because that means rate hikes are imminent in September. Like I said before, it is not necessarily us. We're okay to handle higher rates. Our banks want it, but it's what emerging markets, where a significant amount of mom and pop money via mutual funds are invested in. Mom and pop sitting out there in Idaho or in Oklahoma or in Virginia or in Boston or wherever, or in New Jersey here, they don't even know what the heck the fund managers are investing their money. A good amount of money is sitting in emerging markets because of growth and because of higher yields. Emerging market yields on their bonds are far higher than ours. You've read many articles that I've posted, and on your own you've read it, where they've talked about the hunt for yields. So three things happened on Thursday. Jeff Gundlach, okay, one of the biggest and one of the best fund managers, and he's a real manipulator in my opinion, because he likes to talk. He's like Elon Musk, okay? He'll tweet something, okay? And he basically said the bond market's in a major bubble. That's it, the end of low rates. Watch out. Higher rates means sharply diving bond prices. Watch out. It's going to have a ripple effect. And he's not a stock guy. He's a bond guy. So, but when he talks, the market listens. So Gundlach happened. Rosengren happened. The Fed governor talking hawkish. And then we had the big fat, I won't even get into it, idiot. And he's really bad news. North Korea doing a massive underground nuclear explosion. So everything just happened in one go. And so that's it. That's all the markets needed. Bang! The bears took control, and it was like what we're going to get into the next 5 minutes, and it was just a big full-fledged crash. And those are the three reasons why it happened. Real simple. But the real reason why the money sold off is because bond prices literally collapsed on a one-day basis. And the fear that this breakout, this is a technical breakout. You can see that right there. Okay? That this breakout looks technically that it wants to go up here. And at that point, foreign markets, especially developing markets, are going to really freak. Now, why do they freak? Can anyone, I'm not really putting anyone on the spot, but does anyone have an idea why emerging markets or foreign markets freak when the Federal Reserve raises rates?
Is it because the dollar is going to go higher? Multinational companies are going to have currency headwinds?
You're absolutely correct, but you're looking at it from a U.S. point of view. You're absolutely correct. They'll have currency headwinds. And for people to understand what that means, it means, like Corey said, it means that the dollar is going to be higher. So let's say, for example, GE is selling a massive, $30 million power plant in India is going to cost higher because the dollar's, priced higher. They have to pay more in dollars to buy that. So that's a U.S. perspective. But from an emerging market perspective, can anyone have an idea why they freak out, why emerging markets go ballistically, down, and they get all scared if the Fed starts to talk really tough about raising rates, or if this particular, and this is just one proxy, the 10-year government bond at 1.672%, not 16.72. It's actually 1.672, right? I don't know why they put 16.72, but this is the yield chart. If this climbs up, okay, from here, it's, as you can see, it's a technical breakout. In whichever way you look at it, overbought, no question about it. But can anyone guess why?
No.
Okay, simple answer is that almost 80 to 90% of emerging market debt is based in fill in the blanks.
U.S. dollars.
Oh,
Thank you, Tim. Yes, U.S. dollars. The dollar is king. Remember a couple of years ago, they said, oh, the dollar's finished. You know, it's going to be the Chinese yuan and the renminbi. You know, that's another name. My wife said the other day, what the hell is a renminbi? I said, well, it's a really spicy dish from, you know, Sichuan province. I'm just kidding. I said it's just other. It's actually the technical name for the Chinese currency, the yuan. So saying all that, you're absolutely correct. 80% plus of the world's debt is marked to the U.S. dollar. It's U.S. dollar denominated. What does oil trade in?
Dollars.
The dollars. And I remember a couple of years ago, you know, these gurus were like, no, we're finished. The dollar is no longer king. You know, the Saudis are cutting a deal with the Russians. It's going to be traded in rubles. The Iranians are like, we're not going to pay in U.S. dollars. Like, excuse my French, bullshit. The dollar is going to remain king for as long as I don't know, at least for the next century. Till we lose our dominance as a world economic power. Till nobody wants to come to the U.S. anymore. The U.S. dollar will remain the king currency. Next to the U.S. dollar, what's the second most demanded, highly demanded currency in the world? Can anyone tell me?
Is it the Chinese yuan?
Bullshit. When was the last time you wanted the Chinese yuan? Other than, you know, China's a great country to visit, but no. Somebody else tell me?
Then it's got to be the euro.
Yes, more than the euro, the British pound.
Yes.
Exactly. Okay, the British pound. So the point is that the U.S. dollar, the British pound, and what's the third most safest currency in the world? Take a guess.
German franc.
Which one?
German currency.
That's one. Yes, but
Franc.
more not. But you're close. More than the German
Swiss
franc.
franc.
Thank you. The Swiss franc.
Oh, franc.
Exactly. The Swiss franc. Okay. And I remember once we had a crash of 300, 400 points because the Swiss franc got devalued, if you remember, 2 years ago. Okay. It's like, you know, wonks like us who are into this stuff, you know, I still remember. The Swiss National Bank, the SNB. You know, Switzerland's a tiny country. Some of you might have visited it. You know, I visited it a couple of times. It's just amazing, beautiful place. Just not just from a natural standpoint, but just overall, it's just so unbelievably beautiful. The food, the Swiss. I mean, when you think Swiss, you think luxury, right? So, and that's what they are. So the Swiss franc, when I remember when they devalued once, their bank did, the market just freaked out. So what I'm getting at is, coming back to the original thing, is that's the biggest fear. That if rates rise very quickly, and it's certainly looking to rise, remember, it's not where they rise to. It is how fast they're rising. Okay? It's the acceleration phase that we don't want in the rate front. That is the biggest fear in the highest circles of the global markets. That whether or not, and remember, the Fed doesn't have to raise rates. They just have to talk markets into raising rates. Remember, this breakout, this is a stock. That's a beautiful, you know, like it's a dragon bullish pattern, basically shaping up, or an inverse head and shoulders. Here's a head, here's a left shoulder, right shoulder, multiple right shoulders, basing pattern, and now we broke out. I mean, fantastic stock to buy. So look at it that way. So basically what it means is that we're going towards 1.9 to 2%. But we can't have that happen in a matter of days or weeks. We have to have it slowly. So that's the biggest fear that's driving our choice stocks and clobbering them, because everything is correlated. Now, there are small cap stocks which don't give a crap about what the hell's happening with the US dollar and stuff. That's a different story. I'll throw in one of the ones we own, Clovis. What does Clovis care about what the hell the dollar's doing? Biotechs in general, in my opinion, not just in my opinion, the opinions of some very fine minds out there, okay? I'm just a clueless mind. it's one of the safest bets. Yes, they'll get hit on bad days, but believe me, biotechs in general, the larger biotechs are the least leveraged, means least amount of money borrowed, and they're moving on a different tune. It's whether or not, biotech's biggest threat, to be honest with you, is Hillary Clinton. And not just Hillary Clinton, any other administration that comes says, we don't want drug prices to do this and that. I know drug prices are not fair, but our biotech companies are some of the finest in the world that spend billions and billions and billions of dollars to develop an unbelievable product that saves human lives. So they should be able to price things higher. I don't think they're in the business of putting mom and pop into the ground with the EpiPen scandal. Yes, we're priced high. I know that. It's not funny. We're paying out of my pocket for medical insurance every month as a self-employed individual. But the point is that biotechs, generally speaking, if you look at that sector, is not beholden to currency movements back and forth. Yeah, some of the bigger ones can be because they're selling overseas quite a bit. So getting back to this, we can't afford to have rates rise too rapidly. That's going to unnerve the markets to a point where there's going to be wholesale selling, which has nothing to do with the fundamentals. Baskets of some people ask me, well, why is the stock going down? That's what traders ask a lot of times. Like, why is the stock going down? It had nothing to do with what's going on out there. Absolutely. Because when funds and large institutional players are selling, they're selling baskets. Baskets of the S&P, baskets of the Russell 2000, baskets of the IBB, baskets of the XLF, the financial index. Think, why did Goldman, which was almost positive, go down? I think it was down like $3 by the end of the day. Why? Fundamentally, no reason. They are welcoming higher rates. But there was full-scale, broad-based selling. So before I get into technicals, I'll mention a couple of stats. We had a weird thing happen on Friday. A 11th sector of the Dow Jones was created. I did mention that. You guys are aware of that?
Yes.
You are. Okay, Corey, good. It's a REIT sector, right? Real estate investment trust. Now, REITs have been very, very profitable because rates have been low. REITs are lucrative. A real estate investment trust give a nice dividend yield on the stuff. Lower interest rates help them. But they happen to separate on a day that the market decided to take a dumpster dive. So what do you think happened? There was full-scale selling on that side too. That's the 11th sector of the Dow, which is very good. All 11 sectors of the Dow Jones Industrial Average, ladies and gentlemen, were down on Friday. So here's a couple of quick things as we get into the technicals. So let me cover the macro fund quickly. So we have the interest rate fears. We have Lal Brainerd tomorrow, the lady who's the other Fed governor, who's a dove. If she talks really tough, it could be tricky because she's supposed to be, but then at the same time, the market's a weird animal. They want higher rates, but they don't like higher rates. But the key thing is what's happening with the emerging markets. And I'm going to be watching that carefully to see what's going on out there. And the reality is that we don't want emerging markets to completely collapse, because if they do that, it's not going to do anything good for us, because we're not an isolated island. Okay? So the bottom line is we need to have some, like if she, let's say for example she says, okay, we're data dependent, we're going to move back a little bit, we're going to see what happens. The markets will rally 300 points in 2 minutes, and you'll be like, whoa, what the hell happened? Just like the other times, which we'll see very quickly on many other charts. And you'll be like, boy, that was a great buying opportunity. Believe me, you could turn the market. The Fed has so much power that they can turn the market just by what they're saying, because that's just the way it is. Do I think there's going to be a September rate hike? if we get some strong data this week and next week on the U.S. economy, there will be a September rate hike on the 21st of September. So so if we get a big ugly sell-off like I predicted weeks ago, and I mentioned to all of you, it's going to be the middle of the month, and it happened. I honestly, personally, as a trader and as a person who's gone through quite a few different market cycles, I never thought they would sell the market that hard before 9/11. But they did, because it basically came, a lot of overseas selling came in and dumped on us. Generally, they don't do that. There's a hidden hand of the market which doesn't like to sell the markets off big time before big national events, especially a very tragic event like 9/11. But it happened. So on that respect, I was wrong. Didn't expect that. So saying all that, if we one of the charts we're going to quickly look at is the US dollar. So the US dollar, not that it is, 1 second here, where is the dollar chart?
Hey, Frank, you said that you didn't want the yields to move up too fast. What would you define as being too fast? A week, a month?
No, too fast would be not months. Months would be gradual, like within a matter of a week or two.
Okay.
Yeah, that's, or days, If we get another 3.5% up, like we had 3.5% up on the yields on an absolute basis, right? If you get another 3.5% up on the yields the next day, it's just not good. Not good meaning the markets are not going to like it. So let's take a look at the US dollar here, what it did on Friday. So the US dollar did this on Friday. This is Friday. This is Thursday. I'm going to do Thursday to Friday, right there. Like they say, charts don't lie. So the US dollar basically shot up from pre-market, 6 o'clock in the morning, straight up and till 10. But then it started to ease back. Markets didn't care because the selling was already on, right? So the US dollar is not, it is not showing any major, let's look at an hourly chart. It's really not, if you look at this chart, and you guys are pretty good at looking at charts by now, all the different charts I've shown and everything, this doesn't look like, I know it's an inverse head and shoulder. You got a head here, left shoulder, right shoulder. Everyone see that, right? That pattern. You got a head here. Sorry. And bear with me. I know everyone wants to know, like, I know exactly what everyone's thinking. Like, come on, get into the market. Tell us what's what we need to do going forward. I got news for you. I have no clue. Just kidding. I have some clue based on past experiences with the markets. So, so let's look at the 1 hour chart of the US dollar. These are not easy charts to read, I'll tell you that. So you have a head here, you have a left shoulder, you have a right shoulder, you got a big break here. Here's your neckline. This was the neckline. Everyone understand this pattern, right? It goes like this. There's the head, creates a right shoulder. Very powerful pattern, by the way. Here's your neckline. And once it breaks above the neckline, it moves. Stocks do that all the time. So here it was the neckline, and see you later. It moved, and then it hit this level here and paused and then pulled back. It probably pulled back here. If it really wants to go up to about 96, that's a US dollar index. It's a US dollar index future. It's a DXY. Then it's going to move like that. Now, like Corey correctly pointed out, we don't need the US dollar to move too fast, too quick. If it does that, it creates a pricing pressure on U.S. corporations to sell overseas. Remember, we went through the same problem last year when the U.S. dollar was pretty high. And once U.S. dollar started to weaken, corporate profits started to go higher because it's called currency translation. Very simple. If you're selling into, let's say, Korea, let's say you're selling into Vietnam, which, by the way, is one of our biggest markets. You guys might not know that. We're doing a lot of business with Vietnam, That's the beauty of America. It doesn't matter who we went to war with and what we did. We tend to forgive, forget, and make appeasement as long as the other party is a decent party. So with Vietnam, Their change of governments, they want to grow, they want to do the right thing. They're not like hardcore Ho Chi Minh communists anymore. You know, they're capitalists, they're building bridges, they're building houses, they're doing all kinds of stuff. So we're doing business with them. And Vietnam is a big, big trading partner with the U.S. So saying all that, so if the dollar goes too high, so the next project that Vietnam's buying, they're like, holy cow, we were paying and now we're going to pay like 5% more. Most of their debt is in U.S. dollars. So they're in a big crunch. They're going to pay more and they're going to finance their debt more. So they get into real trouble. So saying all that, the U.S. dollar was at back on at the end of last year in November. You can see that right here was at 100, the index. And as we started to come down, okay, take a guess. What was the last peak in the market before we broke out in July? Okay, it was May. And basically it was actually May of 2015, but when the dollar goes down this low, then obviously, you know, it's kind of, you know, it acts as a B12 type of, you know, sort of boost for U.S. corporations. You don't want to go too low, but low enough. So the bottom line is that we need to stay within this range here. I don't want people to really worry about this too much because it's very important, but I'll remind people time to time. But if we break out of this box here, you can rest assured that the next quarter's earnings, the companies are going to be complaining how their earnings got crimped because of the high dollar, which they did, I remember, back last year. So saying all that, let's dive in right now as to what might be going on, both on the technical front and what we might expect. So let's kick off by looking at the SPX. If anyone has any quick questions and stuff, feel free to stop me. It's an open-ended session. So
Hey, Frank, I got one quick one.
Sure.
Sorry. Don't you believe, since Yellen's, you know, basically a Democrat, and they all want Hillary in, they're most likely aren't going to do rates until December just because they don't want to bomb the market.
Okay, there's a couple of things. The markets will bomb whether it's Yellen or not. Okay, I understand what you're saying. Federal Reserve in general doesn't want to upset the elections, and when we throw in, let's put it this way, when we throw in too much of the political stuff within the context of what's happening with the markets, as traders, we get in trouble. Okay, let me just put it something. I'm a staunch Republican, all right? I have my views. Let's put it this way. I mean, I'll argue with anyone about anything, you know. I'm not like hard right, okay? I'm not alt right. Let me just put it this way, okay? I'm not Breitbart because he's an asshole, all right? And I won't even get into that. But the reality of the situation is that there are people who'll show you, if you look at market stats, and I don't really care about it, okay? But it is market stats, that the biggest bull markets have happened under Democratic presidents. Whether one likes it or not, it has. We had the biggest bull market under Clinton. Not Hillary Clinton, Bill Clinton. It's a fact. We have had a bull market under Obama. I know none of really hardcore, like, you know, that's why I blow people's notions away about being too political. Yes, we can have our differences. And I'm no Democrat, I'll tell you that. But we can have our differences. We have had a bull market since 2009, March 9, 2009 to now. And if this was all fumes, I'm sorry, I don't buy that. People's 401ks have gone from 101ks to 501ks. People's houses, which were submerged, have gone from $500,000 houses, which were down to 200,000, are now worth 700,000. Now, if that's one big conspiracy, fine. Sell your house at 700,000, take it out. I know no one wants to hear that. I'm a practical, pragmatist capitalist. So whether Yellen doesn't want to raise rates, which is partly true, or not, markets will raise rates for her. Didn't markets do that on Friday? Markets will fall and rise regardless of what the Federal Reserve does. Honestly, American business is what has made America great. I know everyone pisses on Wall Street and elitists and all that garbage. I don't want to get into that. Last I checked, the 14 years I spent on Wall Street, I worked like a dog from 7 in the morning till 9 at night. If somebody calls me elitist, they can just go jump off the Brooklyn Bridge. People are ignorant, Corey, in general. Now, are there scumbags on the top of Wall Street who take advantage of the system, of loose monetary policy and such? Absolutely. I'm not denying that. But this massive sort of thing going on, like, this and that, I don't buy that. Because if we live in a world of massive conspiracy theories, then why the heck is the market up 151% from 2009? Is it all about QE? No, it's not. American companies have gained profits, have made profits, have sold more overseas. To me, it's all about American business. It's as simple as that. No dogma. Because the guys who were that dogmatic, and Corey, I know you're not, because you're like, you want AGN to go up and you want, Monsanto to get bought out. Okay? If the markets have gone up that much completely on fumes, then in that case, over the next following 10 years or 5 years, we're going to go to zero. Ain't happening. So answer to your question, yes, they will most probably not raise rates to and Yellen is a Democrat, and she's also a very smart lady, because to me, in reality, we're all Americans. Like I said the other day, it's a very emotional day for me. I almost got blown out of the sky, off the building on 9/11. 99% of traders who talk about patriotism and this and that don't know a shit what happened in New York that day. I was covered in ash, dead people's ash, for 17 hours. So nobody can tell me that I don't know. And I knew some, I wouldn't say good friends, but friends, drinking buddies and stuff, who got blown out of the sky building that morning. So we know. We're New Yorkers. We know. When people sit out there and try to give us a lecture that, we should be so hateful and this and that, I say, go F yourself. And I mean that. And my life is not that matters. It's a matter of 3,000 other people who died that morning, and we used to live across from the water, where from my building, people videotaped people jumping off the buildings. And there were people from all different nationalities, races, religions, and things. They were not all blonde-eyed, blued, Anglo-Saxon mortals. There were people from India. There were people from Bangladesh. There were people from Philippines. There were people from Korea. I mean, I'm talking about actual national origin, who died that day. So let's not get into that bullshit about this and that. And I mean that. So let's move on to finance here, okay? Yes, it's possible that they are not going to raise rate in debt. But will that prop up Clinton? I highly doubt it, because the markets will do what they'll do. And this notion that the Federal Reserve is in a major conspiratorial move, and I mean this, and you guys better listen to it. I'm not here to change anyone's mind, all right? but that they're in some conspiratorial move to like make sure prop up everything is in my opinion, is not hogwash, but it doesn't work. Because the market will do what it'll do. The market is about business. America, United States of America is about business. It's not about race, creed, religion, color, anything. It's about business. When you talk to Jeff Immelt, when you talk to Bill Gates, when you talk to the finest leaders, the biggest leaders of American business, that's what made America great. You think the world says, I want to come to America, because we're a bunch of morons? Because we have the finest businesses in the world making the finest products in many different areas. Yes, because of globalization and the way the world changes, read history, read the Industrial Revolution back in the 1700s, people are displaced during that time. When you go from an agricultural economy to an industrial economy, when the factories were built, there is displacement, there is anger, there is frustration. It happens. It's life. Is it easy? Absolutely not. If I was a coal miner in Virginia, I wouldn't be a happy camper right now. That's why I say education is the ultimate equalizer. Use your frigging brain. Go out there, work like a monster, get good in math and science and computers, and shine. You'll get a job. You want to sit there, drink beer, get wasted, smoke a fat blunt, and then say, oh, I want to get paid $30 an hour. Well, it ain't happening because the world has changed. Now, that doesn't mean that there are no deficiencies in the system. There's a lot of deficiencies in the system that can be fixed. No question about it. But it ain't going back to the old style world where menial jobs got paid a lot. Doesn't work like that. Face it or leave it. Get an education, work hard, do math, do science, take the STEM classes, beat out every single other guy who's going to take your job. I don't want foreigners coming in taking my son's job when he graduates out of college. I don't. But if my son's a lazy bum in college, he's going to suffer. But no one talks about that, right? Everyone wants, we all want welfare. We all want the country to give us what was the case 20 years ago. It ain't happening. Your brain is your ATM machine. Get it going and stop blaming everyone else for everything else. That's my theory. That's the capitalist way of doing things. Don't put your little hand out there and say, oh, I want you to get me back the job I lost 10 years ago. Well, friggin' go retrain yourself. Get out of that cave. Stop thinking like a moron, dogmatic, like I say, that's my favorite term, like dogmatic trader, and just doing what you need to do. That's my theory about doing things. So enough of politics aside. Saying all that, let's take a look at the technicals of what's going on. All right. So this was the big multi-year breakout. And Tim, you remind me of a couple of things on the thing. So now we're getting into it. This is the big fat green line. All right. That was the green line. We broke out of the green line. Look at the date underneath on the 8th of, it was right after July 4th. Remember I said don't short July 4th weekend, all that stuff. So we broke out of that after Brexit. So a couple of really important points. We have to look at previous reference points to figure out how the markets will react in the following week. This was Brexit. We thought the world was going to end. The Brexit charts that I posted during that time is all out there. My videos are out there during Brexit. They were serious stuff. I expected the market to go a little bit lower at that time. In fact, I marked, and let me just draw these directly off these lines here. 1 second. Let me make this thick. Watch carefully, guys. I'm going to make it really, and I'm going to put this as white. There. So why do I draw this line? I draw this line because during a dragon bullish pattern, this is all technicals, okay? You have you have the breakout level, which is right here. Here's your dragon bullish, double bottom, big fat double bottom. Didn't expect the market to go up there, but we never expect anything. We have to look at it from a technical basis. So this was the big breakout point, this 1950. 1950. At that time, the market had gone to 1800. If you remember, we were actually, it extrapolated down to 1650, but of course it didn't do that. It created a massive double bottom, and then we had another major inflection right along that level, which was the 3450 crossover right there. This 3450 crossover, ladies and gentlemen, is an extremely powerful trend indicator, especially when it's on a daily or weekly chart. You guys can look at it, any chart. If you see a 3450 crossover up or down, that will tell you that a trend change is about to take place. Now, a trend change is not a minor word. It means the overall character of the market is changing. We don't have a trend change yet. And we'll see that in a second. So here we had a trend change right after that when the crossover happened. This crossover signified that the markets were going to rip. Doesn't matter. It doesn't mean that we're going to go up every day. We all know that. We get big moves up, multiple candles, minor consolidation, but the general market bias is higher. Here was a negative trend change. That happened middle of, that happened towards the latter part of December, right there. You can see that. The 34 crossed below the 50. And guess what happened? See you later. Of course, this type of massive collapse is something out of the ordinary. These are black swan events. And when they happen, you start to revert back to the mean, like Corey mentioned the other day. So reverting back to the mean is that these lines, which are the 34 and the 50 moving averages, you can use the other averages too, mind you, but I use these because it's worked for me. They're the highways that the market travels on. You can see that. So if you deviate too far away from the highway, well, guess what do you think is going to happen? You want to come back towards the highway. That's called reversion to the mean. Those can translate into big buck for tactical traders, big bucks for tactical traders. Let's say a tactical trader, honestly speaking, doesn't give a crap whether the market's in a bull market or a bear market. That's a real essence, a definition of a tactical trader. All they care about is where they can make money on a technical, tactical basis. That's where we are right now. So the whole philosophy of whether it's a bear market broken or a bull market broken, it's not going to put any money in our pocket, because if the bull market is really broken, and I'll show you a couple of levels where technically it'll tell us that it's broken, we have to wait 3 months. You ready to put a trade on and wait for 3 months and not look at your screen? Fine with me. If you want to do that, then that's more of a macro trade, like The Big Short, the movie, right? They put The Big Short out. It didn't happen in one day. It took 2 years. So traders, we don't have a 2-year time frame. We have a 2 frigging day time frame. And in some traders, they have 2-hour time frames, like I call monkey in a hot tin roof syndrome, right? So so let me finish. So saying all that, this was BREXIT. Okay, this was the 950, 930, if I remember, point drop. 2-day, bang, bang. I was scared. Scared in the sense that I didn't get hurt that much on BREXIT. If you all remember, I called this nice dragon bullish pattern, and it hit there right before BREXIT, because that was the big, this fat dotted green line was the big breakout level. It should take down so many large profits, whatever. It's all listed there. Go scroll down and see it. Then came BREXIT. All right, 900 plus point, almost 1,000 point drop, and then it turned. So how do we determine, as a technical trader with at least some level of technicality and less emotion as to what is happening right now? Because at this point, all we can do is look at pattern symmetry. All we can do, I repeat, is look at pattern symmetry. What happened in the past based on the technicals, and what can we do? So here is the answer. So we have a major fat trend line going up from 1800 to here. That trend line is a major support. Major. Unless we are having a TC or trend change, in which case it'll be see you later back to 1950 or possibly 1800. Some of the bears out there already growling 1800. But if I listen to bears, I'll be sitting in I'll be sitting with no house, no clothes, no food, no clueless day trading service. I'd just be finished. You don't listen to bears, dogmatic bears, neither do you want to listen to dogmatic bulls. You want to play what's in front of you. So this major trend line is somewhere, not somewhere, let's get exact. This trend line is around 2090 to 2100. Okay, 2090 to 2100. Markets are driven by machines. They're mathematical robots who don't care about politics, who don't care about dogmatic philosophy. They just look at momentum and trends. So if that's the case, let's try to be robots a little bit for a change. So you got major level here, and I feel that there are two major support levels. The first support level is obviously the retest of this massive multi-year breakout. I did mention this a few weeks ago. I didn't think it was going to happen that fast. I'll be the first one to admit. But then every time it happens fast. I did say many times, which many of you who follow very closely what I say, I said the drops are going to be sudden. I should have added one other word, violent. The violence, this is a term that I coined many years ago, which is true. The violence on the downside is met by the violence on the upside. That is exactly what happens in markets. Violence on the downside is met with massive violence on the upside if you are dogmatically short. And no one can deny that. If people thought that this was it and Brexit was going to be the end of the world, and they got 1800, the institutions got shorted all the way down to 1800 or at least till 1950. Well, let's say 1800. Said, oh no, we're definitely getting down here. I actually thought we were going to get down here. Okay, because Brexit was bad. It unhinged a lot of correlations between different asset classes. Friday, honestly speaking, didn't unhinge anything. It was just a massive dumpster dive, thanks to the fixed income market freaking out. And all the the frigging nuclear, the North Korean nuclear test, which was pretty serious. So saying all that, it is so if, let's say, for example, they did that, they'll be finished. So we have to go by what we see in front of us. So here are the technicals. Let me clean this out. We have a major support level somewhere between 2080 to 2090. So do the math. We are currently at, 1 second here. I was trying to find my, I'm looking at my other screen, and for some reason, I accidentally erased the E-minis. So I just put it back. Did it come back? That's not it. Yeah, I have it right here. We're down about 4. Okay, so we're going to go to the E-minis in a second. So on the S&P 500, that's the level we're looking at. So if this was a perfect robotic world, then we would be doing this. We would come down, we would short, we would cover a little bit here because this is a major support level. We would bounce about 100 to 150 points, and then we would fail and come down, test this around 2100. In my opinion, nothing gets tested exactly right. Remember, lines can only be drawn in hindsight. People tend to forget that, right? So in hindsight, I couldn't have drawn this line unless the reversal candle happened from here, right? People tend to forget that you can only draw trend lines after the fact. So this one, for example, if it breaks, there is a gap here. And that gap is at, I'll show it to you right now. And then we're going to talk about some strategies, what we can do. This is the gap right there. There's a minor gap. That gap is at around 2040. If it gets to that gap, I can assure you we're going to get down to 2000 really fast. That's a big drop. Now, do drops happen in one complete straight line? Absolutely not. So my feeling is that we're going to get roughly about 100 to 150 point bounce with a 2150 level or so. And then we're going to fall again. This all depends on what happens on September 21st. Now, think about it logically. We are entering September 12th tomorrow, right? So we have 6 trading days or 7 trading days before the 21st. Not calendar days, trading days, right? Do you think the markets are going to be like, oh, whoopee, we're just going to run up into the Fed meeting? I don't think so. The pressure is going to remain on the downside. Rallies, in my opinion, are going to be sold. It's not going to be like dramatic, like 400-point drops every day. But if we look to see what happened during Brexit, we had 2 things. We had 2 big selling days. Remember, selling is propagated by more selling. There's an old saying in the business says selling begets selling, right? And the technical reason behind that is margin selling. You fall really hard, they got to come up with the margin calls. So the point is, you got 2 massive candles. So let's say we get 2 massive candles after a minor pop. Don't rush to buy any pops yet till the technicals shape up. I'm telling you right now. Traders start to get excited. Oh, market's going up. Now we're going to go to the heights. Let's not be stupid. All right? Because there is heavy pressure. There was a lot of 11 sectors were down in one go. That's a lot of money that got wasted. So there are margin calls out there that have to be met. So any move up, what do you think the margin clerks do? They sell to come up with the cash. So saying all that, let's say we get another candle down to retest this level. Realistically, the levels slip. So maybe it slips a little bit lower. I don't think we go to 2050. Well, what the heck do I know at this point? I'll be very honest with you. We are the forces, the global forces that are driving the markets right now, just so you all know, are far bigger than what technical analysis can tell you. This is not technical analysis game. This is a game of flow. So if this breaks really hard, we're going to move to 2050 really fast. If it bounces, we are going to be first bounce should be at the breakout level, which is, and you guys can write this down, is 2120, which I said before, 2120. We bought a bunch of the 2135s and 2130s, which were already up for 4 to 5 points at the close on Friday. Momentum, the way it works is you need a down open and then a reversal. That's the standard procedure with markets. You want a down open on Monday, and then you get a reversal either on Monday or reversal Tuesday. That's the way it works. So if you want to play it, the strategy would be you don't want to rush into anything. If you're really fast trader, you can make a couple of quick points on the S&P or the RUT. No problem with that. Okay, so but if you're not a quick trader and you're looking for some sort of like, okay, I need a little bit more, confirmation, then you need to wait. Just sit in cash. Watch the action, learn from it. So, and of course, I'll be active. I'll be showing like, different stuff. Remember, this is the daily chart. This is a daily chart. So daily charts to reset, which is far from it right now. Okay, let me get into that right now before I move on to the chart. The green line here on the fast stochastics, all right, needs to come down. I repeat, on the daily, in order to get some sort of like definitive bottom, needs to come down here, just the way it did here. Remember, Brexit is our last reference point. Look what it did down here. This turns. The red line, these are all different parameters, right? 80, 20, 10, 3. So I'm just showing you the colors, okay? Just be a visual trader. Don't have to be a rocket scientist. So this is already down there. This is at 0. Good. So the first parameter has been satisfied. But the green one needs to come down here. That could be the push Monday morning into Monday afternoon or even into Tuesday. Now, will this be a total V-shaped reversal? I don't know. I don't know. Why do I think it might be? If, okay, the green line comes here, this line starts to turn, positive divergences. People ask me, so what do I get in? Well, there's no perfect point to get in, but you can start scaling in, because I do believe that over the next 48 to 72 hours, and many of you will attest to that who have been with me, you make the most money that you can dream of, but it comes from a point of maximum grief or despair. Maybe we get that by Monday. Maybe we get that by Monday. And when you see that you can't turn the TV on before these guys are idiots, they're like, oh my God, that's it. This is the end of the world. And they bring Peter Schiff, the gold bug out there, and they bring PIMCO's Bill Gross, who all he's doing is, trying to fool everybody by talking about the end of the world. They all do that. They all do that. The bulls have a lesser voice because fear sells better than hope. I think we all know that in life. I could scare the living daylights out of you, and you'd buy that more than if I really told you that there's going to be some tactical prizes down the road with some sacrifice. Fear sells. All right? Misery loves company. Confidence is hard to sell. Don't forget that. This is behavioral game theory. It's the same thing with frigging stock markets. So the point is, fear sells. So the fear mongers are going to be out there. And they're going to be like, so when it reaches maximum crescendo, both on the social networks, on the Twitterverse, okay, everywhere, on stock twits, that's when you know the markets are in the bottom. How do you know technically? You need to have the green line on the daily come down here. This start to turn, and you'll get a whopping 200 to 300 point snap rally that might not start during the day, might start after hours, which is what happens. Now, some of our traders are futures traders, so they can take advantage of it. Most are not, so they won't be able to take advantage of it. Futures open up 15 points. What do? Chase it? No. If you're positioned long the day before, you sell it. That's the way it works. So this needs to come down and turn. That's when you know you are open for a 24 to 48 hour rally. Now that's on the daily front. So somebody might say, well, what's happening on the short term? Now, let me actually show a couple of other things here. These are histograms, McClellan oscillators. They speak volumes. They're telling you selling pressure. They're telling you capitulation. The standard definition of a capitulation is very high volume, a 9-to-1 down day, except we got a 11-to-1 down day, or 12-to-1 as to advanced decliners. that's considered capitulation. But just like anything in life, a body at rest remains at rest. A body in motion, the law of inertia, right? You guys know that. So in body in motion follows the trajectory of the momentum motion. So in other words, if it's rolling downhill, it's not just going to stop all of a sudden and roll uphill. So the momentum on the downside needs to continue a little bit longer. Now in the old days, it lasted weeks or days. Nowadays, it lasts 5 minutes to maybe an hour. That's why we follow technicals. So saying all that, the McClellan oscillator is right now at minus 147. So let's do this here. What's the most horrific McClellan oscillator? Well, that was back when we had the 1800 level. We got down, if you to almost minus 300. At minus 300, I don't give a crap what technical analysis is. You buy the frigging market. Now, can somebody answer me why markets have reflex bounces? Like one of the reasons. Just think about it for a minute.
Short covering.
Exactly. Thank you very much. Who said that?
Paris.
Hey, Paris. You're absolutely correct. Just the way longs, we like to sell when something spikes up, because we generally don't go short that much, right? Let's face facts, okay? Yes, we do it to SPXs and stuff, but we're not like heavy shorters in the market. So the thing is, just like longs, we like to sell a big spike. Facebook goes up $6 or Netflix jumps up 3. We're like, oh, we bought it here, now we're selling it here. Shorts do the same thing on the opposite. What is the worth of a short if he's simply looking at markets plunge, their P&L getting bigger and bigger because they're short, and if they don't take profit? We all tend to forget what a P&L looks like on our screen means nothing till we monetize it in cash. Do we all agree with that?
Yes.
Exactly. There have been days where I'm like up on something and I'm like, oh, really, like, okay, leave it there for a minute. Like markets are so fast. Like within an hour, I'm like in the red. Like, what the hell happened here? So I always have stops in place. So I take some profits off. But let's say 1 or 2 positions, like leave it in there. Okay, I'm just swinging it. Next thing you know, boom, red. So shorts don't want that to happen either. Shorts are, by the way, more nervous people than longs. They're like really paranoid. Like you're talking caves, guns, beers, everything. I mean, they're taking meth all the way, all right? They're like nervous, paranoid, because they know that the natural tendency of stock markets are to go higher. Look at the stock market chart for the last 100+ years. Has it gone lower? No. It's on a trajectory north, in between large corrections on the way. Really dogmatic shorts, or the real gold bugs who believe the world is ending tomorrow, in which case they should all be dead anyway, they believe that, they always like to paint this picture that the stock market is just going to go to zero. In which case the United States of America will no longer exist, because the stock markets define our identity in the world, whether we like it or not. I love it. I know some people might not like it. Oh, Wall Street's a bunch of corrupt bums, They're all like, this. Come on. The stock markets and American business is what defines America. Dogma does not define America. We know that, right? We know that. We don't like to hear it sometimes, but we know that. Whether we hate American business or not, I don't give a flying you know what. Because American business is what made America great. Our business people, our finest leaders in the American world, in the business world, are the ones who have forged relationship with countries we wouldn't even speak to, and made money for American companies and for American people. Saying all that, I don't want to get into that space. So the histogram right now is down here. So histogram is definitively on the lower side. Now, can it slip down to minus 71? I generally like to love it when histogram gets down this level, minus 200. That's like beautiful. Now, if somebody was clearly a macro trader, now listen carefully what I'm going to show you, please. Watch this. Okay. If somebody was a macro trader and said, you know what, I see a negative divergence on the McClellan oscillator, I'm going to keep shorting the market. In the meantime, the market's going against them and they're like feeling the pain. We're not like that. I'm not that much of a masochist where I'm just going to let my profits keep on getting hit on the long side because I think on the short side because I think the market's going down. But if somebody is a swing trader, they would have seen that the McClellan oscillator peaked on July 12th. Right there. I'm talking about the short-term peak. July 12th. Does everyone see that?
Yes.
Okay. Now let me show you what the markets did. You ready? What was July 12th? The markets were here. So from July 12th, the markets rose from 2170 and stayed in a very tight trading band to about 2200. And all the chart patterns were dictating that the markets looked like it was going to break out of this ascending triangle as well as this symmetrical triangle, and that we could, which I showed also, both the Bollingers, all the technicals showed that we could easily get towards that level. We got close to it. We got to 2195. Okay, but the market, but there was a negative divergence going on since July 12th. Now, somebody who's been bearish and basically lost money all along the way said, "Oh, look, we're very right. The divergence." Well, who gives a crap? Because for the last 3 weeks, all you did was bleed money, and then one day you made some money. So saying all that, this is getting there. It's, in my opinion, it's not there yet. One fact, like I said, respect the candles. This candle is so heavy that regardless of which way you spin it or not spin it, the market needs to go a little bit lower. First level is right here, support level, 2120. Next support level is 20, right this retest of the uptrend line, which is roughly, if this is 2120, then this is 2094. So you're talking of another 30 points. So you're talking 210 plus like about another 250 points on the Dow. Now, will that happen in a straight line? If it happens in a straight line, it's great. And if it doesn't happen in a straight line, then here is plan one. Plan A. The market will hit support and bounce. If you want to play that on a tactical level, feel free to do so. Small amounts, do it. I believe that we still get down here. So if we're going to get down here, what you can do as a plan B is do a spread where you can sell. If you believe that the market's going to hit here and then it's going to bounce, then you can do a straddle too. All right? Or you can go binary, meaning that I'm just going to go straight out short, buy some puts at 2090. But the problem is that this was such a heavy duty move on the daily, and I'm going to show you some short-term time frames right now, that we could just suddenly from nowhere bounce really hard. Futures are down about 6.25 points right now. So I'm going to move on to the futures chart right now. And you can see what's happening there. On the futures, this is the daily chart on the futures. Here's your breakout line. Okay? Remember, the futures are off a little bit, than the S&P, obviously. So we're right there. And if you look at what's happening after hours, as we speak, that lovely green line that needs to get down here is on its way. So if futures open down tomorrow morning, we're down about 6.5 points right now. Let's say they open down 10 or 12. You want to be a buyer, or at least a tactical buyer based on the daily charts. We're getting there. We're not there yet. Look at this lovely McClellan oscillator. It's down to minus 150. Minus 200 would be welcome as a real powerful buying opportunity. Here's a point that I want to make with everyone. All right. The most aggressive times that you can make the most money is the scariest. In other words, at the point where the technicals are looking the most oversold is when no one wants to touch the markets. But that is the time to be the most aggressive. If we all had, like we say in New York, a few money, right? Then you want to take a lump of that and throw it in there, because you know one way or the other, you're going to get a reflex, quote unquote, dead cat bounce that's worth some serious money, which you can sell into. But trying to be the most aggressive at serious tactical bottoms is the hardest thing to do. And that applies to me too. So the point is, saying all that, if you want to play it, you're going to look at that. Now, this is your actual futures chart. Straight line down, beauty. Pattern symmetry. So that's, so the plan 2 is you can basically you can do a straddle, you can buy some calls, and then you simultaneously do some puts. So the puts you do, like I showed on the other side, is the 2090s, betting that the market is going to go to 2090. Okay, on the S&P 500. On the E-minis, obviously, like Tim plays the futures, you're looking at 2080 or so. Now, let's take a look at the what's happening with the actual fundamental moving averages. If you look carefully at what's happening at the moving averages since Brexit, to be honest with you, nothing changed. Nothing changed yet. I don't have a crystal ball. I just try to read the charts better than most people out there and try to keep a sane mind. So if you look at these moving averages right here, ladies and gentlemen, look at it with your own eyes. You're starting to see a slight, you're starting to see the pressure. They're starting to buckle a little bit, but nothing that is different than what happened here. During Brexit, 950-point drop. The moving averages didn't do crap. Look at that. Right there was your first tell that nothing really changed. Was it that easy? No, I'm just showing you what happened. So in this case, the moving averages are still diverged. In other words, they're still separated, which is a good sign. You want the moving averages to be divergently higher. That's still there. Somebody might say, well, if I really look real close, with a magnifying glass, I can start to see them choking down. I said, great. In that case, whatever. I want to be short term during the volatility. I don't know what's going on long term. So the point is that this would be the most optimal buy on the market if you're tracking the E-minis, which is right down here. We seem to be getting there. If we're following the pattern of what happened in Brexit, which I consider to be a major world event, you got two massive candles, right? One, wow, the screen's shaking. So then the two massive candles would bring us down here. So rushing into buy first thing in the morning wouldn't be a wise thing. Waiting a little bit, but then at the same time, I'll be posting quite a bit of stuff. I would say this would be a good buy point. Now, if this is a Brexit pattern, and Tim, you still there?
Yes, I'm still here, and future new low now.
Yeah, I know. Futures are down 850. Doesn't matter. Let it make new lows. You want it to make new lows. That's exactly what I'm showing. So the point is that if this is a Brexit pattern, okay, then we should expect to do the same. A large bearish engulfing, followed by a minor follow through, which would bring us down here, and then if it's a Brexit pattern, then you get the first candle, the second candle, the third candle. And remember, when the first candle is forming, it happens very quickly. Very quickly. It's like you can't even turn your head. And if I'm like saying, okay, buy SPX calls like, 2090 or 2100, whatever the case may be, you blink of an eye, it'll be up like 10, 20, 30%. So all you want to do is play with small amounts of money, because remember, we're getting to a point, and this is the most important thing I'll say tonight. We're getting to a point here, ladies and gentlemen, where small amounts can get big. You put big amounts in the market right now, I can assure you, you will be a nervous Nelly to the point like a monkey in a hot tin roof doesn't even do justice. You'll be like a gorilla on fire. All right, you'll be selling so fast on 1 or 2 points higher, while the market can, I mean, the SPX calls or whatever, I'm just taking one example, it might be up 7 points, but you'll be gone at like 1 or 2 points and be like, what the hell? Because the larger the money, you just want to grab your profits and run. You want to play with small amounts. Play with 1 call, play with 2 calls, play with 3 calls, I don't care. But small can get big if we follow the 3-candle move like we generally see and most recently saw after the Brexit crash. Just want to be clear on that. Now, for the candle development to happen, I'll certainly alert people. Candle developments have been very fake lately, both on the upside and the downside. You'll know that. And I use the Quad Algo HFT platform to notify people. But even then, you know, it's very tricky. But this is very defined for me. I feel that this is a level of a reversal bounce. Will the reversal bounce go like this? I have no frigging idea. Did I think Brexit was going to come back and we're going to go straight up? I had no idea. I just simply showed the probabilities of that happening. Now, how do you determine probabilities? One of the easiest ways to determine probability is to look at some simple internals. And if you look at simple internals, you will see that we are getting there. Green line is almost there. Last time on Brexit, it turned right here, right there. So it needs to get down here. Futures at down 10. Great. Foreign market selling off. You know, there's natural momentum. I mean, just because just remember one thing. All markets are interconnected. So a foreign money manager who's got a lot of money in the U.S. too, who's buying U.S. stocks, he has to basically now cover his margin calls and stuff in his markets, whether it be in Dubai or in Singapore or in Hong Kong and in Japan, right? So that's what's going on right now. So what's happening with the futures right now means nothing. I know somebody will say, oh, you're stupid. He's saying it means nothing. It means really nothing. What happens during our market hours means something to us. So saying all that, if you start to see this, the red line starting to bottom, real simple, act. Now that's a daily. Let's take a look at the weekly. 1 second. I'm sorry. What am I saying? Weekly. Yeah, let's take a look at the weekly. That's the one that I saw at the end of the day. And 1 second. Let me clean this out. And all the perspective that I'm giving you is it's actionable. It's not something that you can say, oh yeah, I learned a lot about market history, you know, good stuff. No, it's actionable. Only if you act. Remember, I put a lot of actionable ideas out there, but 1 second. But the question you have to ask yourself is, are you acting on them? Because that famous saying, it's better to have tried and failed to never have tried at all. So it doesn't mean you have to go in there with huge amounts of money and make a huge mistake by trying to chase something, and then these tactical moves go back and forth. But have something in there which can do something for you. So better to have tried and failed than have done nothing at all. Never forget that. That's the motto. And anyway, that's the way I lead my life. So saying all that, on the weekly, this is a weekly chart. I'm trying to get close. 1 second. So on the weekly chart, somebody said, well, where do you think the market's going? Well, I said, okay, I'll tell you what the market's going. So on the weekly, if you look at it on the S&P, we're still seeing the same thing as the daily. This uptrend line is a major support level right there. Brexit. I'm sorry, this was Brexit. But this is an uptrend line from the lows of 1800. Gotta respect it. that uptrend line breaks in a big way, there are supports below. What happened here on the weekly basis is, somebody mentioned this too earlier on, is we moved too far, too fast away. And it didn't happen with all stocks, which I want to show on my next chart. Is you hear a term in the news, volatility is back. We had no volatility. We were just moving, everything was just going higher and higher. Bunch of liars. We have had such intense volatility in the past 2-3 months, and I've shown them clearly, between individual stocks that have been down $20 and up $20 and earnings which have been down $15 and up $15. We have had enough volatility. But if you listen to the manipulators in the media who are talking their own books and lying to the investment public, and I mean that, they say, oh, there's been no volatility. Haven't you heard that over the last couple of, since Friday? That volatility,
Yes.
You heard that a
Yes.
lot, yes. And they're lying, because I will show through the charts on the next chart that we have had intense volatility. Yes, the volatility has been capped at 200 points, maybe at 100 points, but we have had volatility. Why do we always need 400-point volatility? Who does it really make money for? Other than the bears who've been losing money, dogmatic bears, and finally they made a little bit of money, other than big brokerage firms which make a lot of money on panic sellers and commissions. Does mom and pop love volatility? Never. So, but they make it sound like, oh, volatility is really good. The market's not. They're liars. Volatility, intense volatility from nowhere is never good. It scares the living daylights out of the average American investor who does not even want to put a single dollar in any U.S. company. That net is bad. They individually, American investors have put literally no money and dragged so much money out of the market since 2009, yet the market is up more than 150%, not to mention individual stocks that are up close to 600%. Certain individual stocks. But mom and pop is nowhere there. Yes, their mutual funds have gone up. Their 401ks have doubled, close to it. Their pension funds have doubled, thank God. But have they put individual money in the market? No, because every time they turn on the TV, there's somebody telling them that this is a house of cards that is full of crap, that the U.S. is dying. American companies are just faking everything. They're all a bunch of greedy bums who want to steal your money and all the garbage that they hear. In the meantime, they could have made themselves really rich. And that includes a lot of you too. But you didn't. So every time the market went up, you thought, oh my God, how much more can it fall? Because that's really what goes on in people's head. I know that. Every time the market went up, how much more can it fall? And now that is correcting a little bit. That's happened so many times. Every single one of these candles equals this candle. Nothing new. Now it's like, oh, is this the big one? No, it's not the big one. It is a correction. It's not the big one. So, and I don't know what the big one is. The big one is when when a meteoroid hits Earth and we're done. The only thing surviving will be the clueless trading website, just there, sitting there, and in the scars of it, Mad Max comes out and he goes, whoa, I found the Holy Grail. It's called the Clueless Trading website. And there'll be pictures of it and we'll be like burnt ash, gone. That's called the big one. I'm serious. It's so pathetic, the crap that I hear out. As I get older and hopefully wiser, not that my wife and kid tell me that, just kidding. But the thing is, I realize how pathetic people are when they talk garbage. But they live in the garbage, so they believe the garbage. They just said, no problem. Here comes the big one. It's the big frigging one. Okay, great. What's the big one? A 1,000-point drop? Yeah, we just got it 2 months ago. Less than 3 months ago, called BREXIT. What's the big one? 3,000-point drop. It happens in one day. Big one, my butt. Yes, there will be big one. There'll be big corrections along the way. I talked about it. Talked about September and October being very volatile. We're seeing it. Now, let's get back to the technicals before the big one hits and this webinar just goes up in in flames. So let me just put this through. Sorry, I'm very unscripted. Okay, I just think what's in my head. I'm a half reasonably intelligent guy, I think. So forgive me if I'm a little bit vocal in my opinions, which is totally fine. A man without an opinion is not a man. You know who said that? Anyone know who said that?
No.
Dick Tracy said that in the cartoon movie. All right, a man without a man without a man without opinion is no man. And it's true. You got to have an opinion, right or wrong. One of my first bosses in Wall Street told me that. You want to be a great what do you call it on the wealth management side? You want to sell a great product to or bring in a big institutional client? Have an opinion. Right or wrong, he's going to respect you because you had an opinion, not like, oh, well, maybe, maybe, it's going to. That's what analysts, these idiots do on TV. Oh, well, maybe this is going to happen, maybe that's going to happen. Like crap. Have an opinion. Don't have to be dogmatic, but have an opinion. That's what we're doing here. So here's my opinion. This is a weekly chart of the S&P 500. If you look at the internals, we're going down. Now, that's a weekly chart. So this going down, I believe, will culminate by October. It won't be straight down. We're going to get reflex bounces, but they need to be, in my opinion, sold. So if you look at this here, pure and simple stochastics, which have worked all the time, you get major bottoms in the market. I'm talking major bottoms, not like minor bottoms. Major bottoms in the market when you get deep oversold. Are we deep oversold? Nope. Is it possible that the lines just suddenly from nowhere, turned in midair? Yes, it certainly is. But it's few and far between that happens, right? Most of the times, in order to get a definitive bottom in the market, you tend to get, you need to get down towards oversold levels. All right. So another 150 or 200 points, I believe, should get us on a weekly oversold basis. 100 to 150 points on the Dow or more, maybe 300 points. Saying all that, look what's going on here on the front side, which is the external side. And this is a definitive opinion. We went ballistic on what happened after Brexit as the big institutional, big monsters who were short the market got a lottery ticket. I talked about it many times to remind people. George Soros, Carl Icahn, Stanley Druckenmiller, who's one of George Soros's ex-lieutenants on the Soros funds. What's the other guy's name? Bill Gross. He's like the little mouse which follows the big guys, Seriously, I have very little respect for Bill Gross. And so you get all these guys basically short, big money, bang. So they get the lottery ticket, they cover. That's why you get this candle. This candle impaled the bears who had no idea what the hell was going on, right? And it continued. So once it continues, now we're having a reversal pattern. So if it's a reversal pattern and this is not sold out, look what happened. We moved away from the 34 and the 50 like nobody's business. It's like a party gone wild if you look at it from a technical perspective. So from a technical standpoint, there was certainly euphoria. There's no question about it, right? Because look at the standard deviation, which Tim understands well, okay? Standard deviation on the weekly from here to there. Just look at the visual standard deviation. It was almost equal to this. Because I'm a visual trader, okay? So look, this is your 50 and 34. Look where we had dropped, and here's the 50 and the 34. Look where we rose. Honestly, if you just look at it quickly, it's the same length. So what's going on right now? We're seeing a massive weekly mean reversion. What does that mean? It means that we are going to come close to the rising. Here's the key word, the rising 50 and the 34 moving average. That's a good thing. Rising means it's rising. That means positive. A rising 50 and the 34 on the weekly is very, very constructive as long as it's rising and splitting, creating the spread between the 50 and the 34 keeps on spreading wider. So if this is rising, then the markets will find massive support at the rising 50 and the 34 moving average. Will it be down here at 2060, 2080? I don't know. All I know that as long as the 50 and the 34 are rising that fast, that quickly, then the markets are not entering a long-term bear market. Is that clear with everyone?
Yes.
That's it.
Yes.
You don't need to believe me. It's such simple stuff because I reminded people, I told people many times. I tell you again. Keep this reasonably short because it's getting late. I sat under because we used to have all these very specialized seminars and stuff. Some of the biggest names: Ralph Acampora, Louis Yamada. These are big names in the 90s. And they're still around. Louis Yamada is probably like 110 years old. Very fashionable lady. She's very rich. You've probably seen her on TV. Ultimate technicians, because at that time there were very few real technicians. So when they spoke, the markets moved. Ralph Acampora, like, whoa, So the thing is, and he's still very good. So these guys, but then the machines took over. So those guys are still around. But I learned a bunch from sitting there. And then I applied my own stuff. And I said, honestly, it's not that hard. What's hard is applying your own money as we are discussing these things. That's the hard part. The hard part is not this looking at the stuff. I mean, come on, it's like a bar coming down, showing the lines. Okay, it's got to get there. But the question is, when your money goes into play, that's when we all freak out. So let's try to keep this simple. So at this point, if this seems to be the zone that the market wants to come and retest, so that's still around 2090, 2100, right? Let me try to see this out. Hold on one second. I'll draw a price level, I would say here. Yep, 2080, 2090. Now, there's an article that I'll post out there. I read over the weekend, and I didn't want to inundate the Twitter feed with technical articles and stuff in respect for 9/11. So I didn't put that out there, but I'll do it tonight. This guy's, I can't say his name. He's Serbian or something. Kolonev. He's JP Morgan guy. That guy's like ultimate quant numbers guy. And he's been very right on technical markets. So he's saying that we have another 3% down on the market, which is good. So let's somebody tell me quickly if they have the screens open. Where did the SPX close at? Let me see here. Where did the S&P close at? 2127. Okay, minus 3% is 2063. Okay. Roughly about 64 points down on the S&P. So let's look at 2063. 2063 is somewhere around here. There. So he's saying, oh, we just talked about it. And this guy is really good, okay? He's a rocket scientist, with his algorithmic pattern stuff. But he's basically saying, yes, we could get bounces and all that standard stuff that happens, but we are going to get another 3% down before all is said and done. So if that's the case, isn't that we just talked about right now, that we're going to basically kiss the uptrending 34 and the 50? It's right there, 2064. That's 3%. Now, if it happens in a straight line and we catch that through puts, that'd be beautiful. Honestly. So one way or the other, you got to either do a straddle, or you got to, if you're being tactical, you got to be glued to the screen. But I think the pressure is on the downside. So if you want to do a swing trade, then you want to buy the 2100s or so on the SPX and sit there. Here's the problem. Here's the problem. So for now, let me just cover the technical levels. So testing the uptrend line is around 2085, 2090. Retesting and this is static, of course, based on Friday's closes, is 2070. These are good money. These are good money because we're at 2127. One way or the other, you got now we're down 16 points on the E-minis. Nice.
Yeah.
We're at 2100 right now. Yep. So let's see what's happening on the E-mini side. So E-mini side, this is a weekly chart, okay? We are about to go and hit this by the open. I mean, I would be surprised if we're down about 20 plus at the open, right there. See that? Now, the reason we're putting this all through, there's nothing to really panic about. We just have to sit back and understand that this is the nature of the beast. So the nature of the beast is telling us that we are going to touch the uptrend line here, and this one on the E-minis is 2065. So one way or the other, the faster we get there, the better off we have it, a real powerful bounce. This is deep oversold right now. It's at minus 0.07. The red line on the fast stochastic, I believe it's the 80. So it's like really fast. This one should be down to minus 100. It's not there yet. The McClellan oscillator. It's all mechanical what's happening right now. We would like to see this starting to make a little V-shaped move and the green line from slightly lower level start to make a move up. Just the way it did here during Brexit. And bang, within 24 hours, you clean house and you get out. That's it. Now, before that, you got to come down lower. So this, as long as these lines on the weekly are climbing higher, we're okay. When you start to see these babies, when you start to see these two lines go like this, starting to falter, and they don't falter like in one day. It has to be multiple down days before the weekly moving averages, that's what they are, weekly moving averages. They're carrying a lot of days behind it, right? That's what moving averages are. Starting to buckle, that means that you can stay short for a month or two, no problem. That would be what I would call an intermediate big short. Once we start to see the lines start to curl down and cross over, it doesn't matter whether you have a one-day rally or two-day rally. That means the market has a trend change. We haven't seen that yet, just so you know that. So right now, this is what we're seeing. And this is, this is where we are. Now, here's the problem, all right? The problem is we have a monthly options expiration coming up on the 16th. Monthly options expiration, 90% of the time, are biased on the upside. It might start on a Thursday morning. It might start on a Thursday afternoon. But one way or the other, by Friday morning, by the first part of the day, and then it starts to, all the option premiums start to basically just, deteriorate after 12, 1 o'clock. But the first part of it, they bang the market up. So if we get a real big sell-off, they're going to run this market higher starting Wednesday. Now, let's take a look at the dates because that's important. Friday is the 16th, monthly options expiration. The more negative the market gets, the algos will kill the shorts by Friday. I'll venture out and say that, to me, as a personal opinion, is a guarantee. I've seen that happen way too many times. Okay, so, but the 20th is the Fed meeting. 21st is the Fed announcement, which is Wednesday, 21st Wednesday. Honestly speaking, if the Fed doesn't do anything, the markets will rally. It'll just rip the heads out of people. Because at this point, what the markets are messaging to the Fed is don't raise rates in September. We have had some weak economic numbers lately, right? The ISM numbers and stuff. So take it easy. And the US markets are saying that. The international markets are saying that. So if the Fed listens to that and then doesn't raise rates in September, you're going to get one powerful rally which will rip the heads out of people. Then, same old story. Probably sell off after that. But you will get a rally on that. Now, that's next Tuesday, okay? Not this Tuesday, but next Tuesday. That's on the next Wednesday, the 21st. So, and then maybe the market sell off like crazy the first part of October, which it always does. Remember, mid-October has always been a mini market crash. Always. Last year, 1987, the year before, it's always the same. So whatever you do, you can't sit back and say, oh yeah, the market's now making a new high. It ain't going to be like that. We're just looking at technical levels here. Let's take a look at the E-minis on the 1 hour side. This is what you call a waterfall, complete waterfall impulse decline. Like, that's it. Throw the baby with the bathwater, take the grandma and the grandpa and throw them out too. Okay? That's it. It's over. So this is good in a way, because on the 1 hour charts, as you're playing tactical, you're seeing that the stochastics don't go down anymore, because they can't go down anymore. You don't go below. Look on the right side. Somebody tell me what it is. What's the level?
Minus 104.
Correct.
107.
Correct. So you normally don't go below that on sell-offs, okay? And if you look at the 4 hour, the most we ever got to during Brexit, remember Brexit's your last reference point, we went to minus 0.007. We're almost there. So this is between Brexit and now. Look at that. So, and look to see what happened. This was Brexit. This was Brexit. Look where the McClellan oscillator was. Okay, this was the last big sell-off, which was August, or first week in August. Look where we are right now. We're getting pretty close. We get to minus 300, buy with hands down. Maybe one hand, not with hands down. Like, you got to be careful. I mean, anything can happen. There could be more bad stuff coming down, and I mean, we always have to keep an eye, over our shoulders. But we're getting there. These are tactical buys, big time buys. Now, these big time buys, you need to take your profits within the first 24 to 48 hours, or within the same day. Personally, I wouldn't really roll things overnight too much, but leave a little position depending on what the technicals are telling us if they get that deep oversold as we covered it. Does everyone understand that?
Yes.
Yeah. Remember, we're not looking for miracles here, but I do know one thing from past experience is small gets really big. So put a small amount down. Let it get really big. And if it really blows up, at least you won't get that hurt. Whether it be one call at 400, whether it be 10 calls at 4,000, whether it be 5 calls at 2,000, treat it like this. I've done it before. It's risk money. Like if that goes completely, blows up, you're not going to be on the street. So put a small amount down and say, listen, it's getting to that level. I see it. We talked about it at these advanced coaching sessions. We looked at all the histograms, the technicals and stochastic were there. I'm throwing it in there. So you buy the end of the week ones going into September 16th, which is the monthly option expiration, I repeat, is historically a very bullish event. I have shown that repeatedly. Now, if you wait around for the market to turn and show you whatever, by that time, the tactical sellers are selling. So you got to buy at the point of maximum pain as long as the internals are the deepest oversold. Deepest oversold. My algo charts right now, which is on my other terminal, let me see what they're doing, because those are real time too, are right now, and those charts right now have the 9th red candle on the hourly. Like, wow, sweet. I mean, it just looks like a piñata, just, what they call it? Mexican piñata, just being smashed. 9th red candle, straight down. And here's the beauty, and I know I do the recordings and I throw it out there, with some limited commentary in there, is the slow stochastics have stopped going down. You guys understand what I'm talking about, right? The algo HFT charts, I show the fast stochastics and the slow. Yes. So the slow stochastic right now, as I turn my head to the right and look at my 6th screen, they stop going down. Yet the candle is off the charts, like it's just going straight down, because that's real time too on the SPYs. And so what it's telling me is it's a process. It's like right now it's getting to a point where it's just like, Okay, let's just take it down there. Let's do the heavy dumpster diving, and then we'll see what happens. Once those slow stochastics start on the quad HFT platform, and that's a very powerful platform, and that's what happened as recently as, just to remind everyone, September 1st at 11 a.m., we reached a low on the market, which we lost, by the way, on Friday, which was 216 on the SPYs. And we had that same level hit on the 26th of August at 2 p.m., which was 216 on the SPY. We lost both those levels. So the logical move would be, given where we are, and both that time, the slow stows went to exactly the deep oversold condition, which is a big fat zero. You can't go any below zero on the slow stows, just so you know that, because this one, the quad platform is the metrics are based on some sort of algorithmic algo HFT platform. So the numbers are a little bit different than Thinkorswim, what you're looking at. You can't go below zero. So once you start to see that, so the most logical move would be that we jump from 213 on the SPYs to 216, which would bring us to, which is pretty substantial money. You guys know that, you know? So I'm watching that, and I'll see what happens in the morning, but that's like incredible. But it's exact pattern symmetry to what happened on October 26th. I'm sorry, August 26th and September 1st, except those were higher levels. So this type of candle breakdown that we're seeing is a clear indication that there is some big scale bond blow up happening. And good for them, because everyone's sitting there like thinking bonds are the safest things in the world. Now that rates are rising, they're panicking, they're back out. You want to know, if you want to learn more about it or understand more about it, just type in the Gundlach article, Gundlach. He warned people about that on Thursday. He said the bubble is bursting. And when bond bubbles burst, this is what happens. Eventually, it's actually very healthy for equities, but in the short term, it takes everything down with it. So this is what I would be looking at on the what do you call it, histogram wise. I'm looking at, if we get close to 300, please, best strategy would be, in my opinion, would be to take a portion, let's say buy a couple of contracts or one contract, I don't care. You can buy in the money a contract, maybe it costs $9, whatever, and just say, you know what, I'm leaving that in there. Let it go. Because the biggest fundamental mistakes, ladies and gentlemen, I have made is when I have bought aggressively at the bottom and sold too early, and then tried to scale in again at a higher price and sold too early. Yes, I made staggered profits, but it's no good. I would love to buy, just say, okay, this is the bottom, give or take a point or two. And I've done that here and there. But to hold on to that core position and have the discipline, because I don't BS around, I'm telling you the honest truth, have the discipline of saying, you know what, this is what the pattern symmetry dictates, this is what it's done before, and at this point we are obviously using BREXIT as a reference point, okay? This is what it's done before, and I'm going to hold on. Because when that move comes, and when the BREXIT move comes, there is no time to buy. I mean, you buy, you sell, then what do you buy again? It keeps on moving higher. And then you get this bear killing 3450 cross. Except it happens like a couple of days later. In this case, you know, we are just seeing a kind of a flat line on the thing. Look at this. This is your 50 and the 34. Standard deviation, moving averages, forget about it. I mean, it's like a huge standard deviation from the moving averages. I mean, it's like, I would just visually say that's like a -5. Tim, what do you say?
I usually I can put in -3, but you said -5.
Somewhere like -4 or 5. I mean, visually from what I know that you know, this thing. So that's a pretty high. I mean, just you can clearly see that's quite a bit, but it can obviously swing a little bit lower too. So so anyway, so that's what I would do. So plan A would be, okay, here's the plan. The Plan A for non-active traders is just sit in cash. Sit in cash, wait for like really down, look at all the alerts that I'm putting through, then decide what you want to do. Plan B is jump in there with a depending on where we open up tomorrow morning, jump in there with a small amount on the long side. I prefer in the money at this point because we don't know where we're going to slip to, and just sit there with it. Plan C is you can do a straddle. So because you can do a straddle. You can buy, you can buy the 2100. I'm sorry, you can buy wherever we open up. Let's say you can buy the 2120, and you can do a spread. You know better. Some people do spreads very well. You can buy the 2120 and maybe sell the 2130s. So you can basically get some premium in and cover and lower your cost on the calls. Shorting like big time of these levels might be a dangerous move given what we are seeing on the internals. That's my suggestion to people. That's all. Now, tactical shorting that we can fall another 30, 40 S&P points. I showed that absolutely. But I think that comes after we get a quick reversal bounce. The reversal bounce might come, and I repeat, on Lael Brainerd's speech tomorrow morning at around 10, I think it's around 10 or 11 a.m. The last Fed governor to speak before the quiet period, before the Fed meeting. Does everyone understand that?
Yes.
And that one lady can easily, and I've seen way too many of these things, can blow the crap out of the hardcore shorters in one single thing by saying, you know what, I don't think we should be in a real rush, whatever. If she is very hawkish, like we heard from Rosengrant on Friday, like, no, the economy is great, we're raising rates, then the market will fulfill and retest those levels another 100 to 200 points lower very, very quickly.
What do you see could happen tonight? It looks like overseas are at, and China is doing something over the sea.
Yeah, basically there's a couple of things going on right now that you have. We're going to look at that. That's a good question. 1 second here. I'm going to 1 second. Yes, DJPY. Okay, if you look at because this is a major factor, the Japanese yen spot, right? So what's happening right now is as the dollar is spiking, it's not actually spiking that much, but as the dollar is basically strengthening somewhat, you are starting to see the, let me clean this out. Let me just answer that question in a very straightforward way on a shorter term basis, let's say 15 minutes. So the yen right now is in a very constructive formation, okay? The yen base is around 101. If you look at this formation, this is basically the pattern symmetry is this. Watch. Double bottom, right shoulder, right, to basically slowly go here and then here. Now, with the yen weakening versus the dollar, you guys all understand that. The US dollar Japanese yen spot means that if it's at 104, then our lovely greenback, $1 buys 104 yen. Time to party in Tokyo, right? Okay, so it's exactly what it is. It means the carry trade is on. A weaker yen is good for global equities in general because the yen is it's a function. Basically, the carry trade means that large institutional global traders borrow Japanese yen to trade in Japanese markets, which flows into the U.S. markets and blah, blah, blah. It's called a carry trade. So if the yen is weaker versus the U.S. dollar, they have more firepower to buy the yen. Does everyone understand that?
Yes.
That's called a risk-on trade. So with the yen now rising, I mean, it's actually not rising, it is weakening, okay? The yen rises when it falls below this number. If it's down at 100, that means $1 can only buy, I'm putting Y, can only buy $1 US can only buy 100 yen. That means the yen is stronger. Everyone understand that part, right?
Yes.
Exactly. So the higher the number on the yen is, because it's an inverse relationship between the US dollar, then good. So saying all that, in overseas market right now, the flip back of the flip side of a strengthening dollar is the fact that, one second, is the Japanese yen. The Japanese yen's weakening, which means the global markets are taking on more risk. And that's something that could stabilize markets. We're down about 1175 right now. You cannot tell by looking at the futures markets right now. I can show you a little bit. Here's a 5-minute chart. What's happening, right? So this is not telling, yeah, on the 5-minute chart, if you're a futures trader, which you're Tim, you could actually trade this right up to overbought levels. You can trade the spot right now from this 2100 or 2099 up to here, 2110. You could possibly get 8 points right now on the futures as we speak, just based on the 5-minute chart. If you look at the 1 hour, you're not going to do anything because it's still on sell mode. If you look at, even though you're starting to see some improvement on the underlying, no, you're not seeing any improvement. I'm not seeing that. So all you can work off if you're a futures trader right now is the 5 and 15-minute charts. The 15-minute charts are starting to show a small candle formation. Let's take all the lines out, remove all drawings. If you're relying on all you have to rely on is the stochastics. The 15-minute stochastics are telling you that right now the upper Darvas is 2111. Where is the spot right now on the E-minis? It's at 2104. You could, as a fast trader, make about 7 points in the E-mini probably in the next 15 minutes. Okay? Because that's exactly what the formation is. And it'll get overbought, you sell. Now that's for futures traders. Now, saying all that, do we see any change in the underlying histograms? None. McClellan oscillator? None whatsoever. So it's too early to tell. I think the selling pressure will remain first part of the morning. And if futures open up big, I think if we, the selected long positions like the Netflixes and this and that, not the swing position, the Clovis, Monsanto, I'm just leaving aside, you know, I think those things are fine. So, but any sort of tactical trading positions, you want to sell. If we open up like, 15, let's say anywhere north of 6 or 7 S&P handles higher, sell. Sit back. Because there's a lot of selling, a lot of margin pressure still built into the markets. They need to be taken out. So any type of, let's say the market opens up 100 points on the Dow. That's a sell. That's it. That's a sell signal because they'll sell first. That's every single time it happens the same. They'll sell first. If the market opens down deep red, like let's say the market opens down 200 points, that's a buy, in my opinion. Okay.
All right, quick question. What
Yes.
happens if it opens up like 100 points down?
Then you sell your tactical trading longs fast. Not the swings, not the Monsantos, in my opinion, not the Clovis, not those small cap stocks, which are swings. But let's say the Netflixes or the Teslas open up 2, 3, 4, not 2, 3. Yeah, Tesla can open up $4 anyway. But Netflix opens up 2, 3. I think it's a sell.
Okay.
Yeah, that's my opinion.
Thank you.
Yep, because this is what happened on Friday is pretty serious stuff. And that's a lot. There's some chunky margin calls out there that needs to be satisfied. But the sooner they get satisfied, the better off we are. So I'll be watching the internals very carefully on behalf of all of you guys, ladies and gentlemen, and for myself. And then we'll see. Leave cash on the side. But I'll tell you one thing. Once that big reflex bounce, it's going to start off very quickly. It's going to be a little jerky, but you got to stick tight, play small, and take in some big money back. That's my opinion. If it follows the Brexit move like we saw, oh Lord, we are in for a big thing. Now, there's a couple of guys that I read, I've been reading, I've been reviewing my stuff all weekend, quickly looking at my phone. There's a couple of guys on the technical side who are basically saying nothing changed because all we did was give back 1 week's worth of gains. You get it? So if that's the case, we are still within the box, and I'll show you.
Hey, Clue, do you think that back in Brexit, you said you felt that was a shorts getting out of jail? Do you think the same thing could be this time too?
Could be. You have a very good point. It could be, but I still think that this pattern just purely be, the only thing that bothers me is the fact that we are moving so fast to the downside that I would love to like go in there heavy short first thing Monday, right? But then I'm going to get burned. Oh, here's the biggest technical indicator. When you get to see me get too bearish, do me a favor, buy long, okay? Because I'm telling you straight out, when I start to get like, oh, I'm telling you, it's the worst thing because I'm human too, okay? But when you start, if I start like ranting, like, okay, that's it, you know, we're heading down like 300-400 points, do me a favor, you don't need to even tell me, just go out there and buy a couple of calls, all right? Because it's going to go the other way. But just these levels are pretty well defined, as you can see. We have 2075, 2080, but I think this big fat breakout line, which I had predicted weeks ago would get retested, is going to get retested. Now, talking about individual stocks per se, some stocks are going to do some weird things, by the way, because some fund managers who were sitting on the sidelines, like Corey correctly pointed out, they are going to be big buyers into these pullbacks, because there's a lot of, not all fund managers think alike, right? Some guys are long term. Some guys are thinking, hey, that's great. You know, give me some sale prices on Amazon and give me some sale prices on Netflix and Tesla. Look at that stock Finisar. I just had a little bit. That thing was up frigging huge. That Finisar is probably going to go to $30. So there'll be selected stocks that I'm putting out there, you know, which I think biotechs are a good spot to get in my opinion. Selected ones. Oh, last thing I'm going to look at before we go is let's take a good look at the VIX. The VIX.
Hey,
yes.
Frank, you left some note on the Twitter feed that you said you found some revelation that you back tested.
Oh yeah, the one that I saw, which was actually I was pretty excited when I saw it, was actually the weekly chart on the S&P. Okay, because that one I don't normally look at that much, and the weekly chart on the S&P basically told me that we were so this was a revelation I had. I didn't realize how far the standard deviation or the distance traveled from the moving averages we were before, you know, on the thing, and I should have seen it, right? At least noticed it, you know. So that was my revelation, that this correction was kind of overdue, because I didn't realize how far we were from this, but by now we're already coming, you know, we're already, you know, closing the gap. So that was my personal revelation as I was looking through different things, that this was nothing out of the ordinary. It was simply a mean reversion play that's happening, and of course it's happening for, you know, like I said, every crisis is the same for different reasons. So that's what I was talking about, Corey. You know what I'm saying? So at this point, I repeat again, you got support here, and then you got support here, and I personally don't think that the market's ready to croak, meaning like completely break down below the moving averages, in which case we have a trend change, in which case you short every rally that you get. But I don't see that happening right now yet, till it gets there. So that's the thing. Any other quick questions?
Frank, I have a quick question, please.
Yes.
Why not, since I've been trading the SPX, why are there now like 3 expiration days during the week?
I have no idea. They put it out there, and I'll tell you why. It's all a game of money, right? It's about where they can make the most money. So the Chicago Board of Options Exchange decided that the market's going to get volatile. So a lot of fund managers demand risk, event risk, right? So they don't want to pay up a month out, because we don't even have an idea what's going to happen a month out. Seashell, okay? So what's happening is they put these cheap ones in there so you can literally play day by day based on events that are taking place day by day. So because of demand from a lot of hedge funds and not a lot, but some mutual funds and institutional fund managers, the CBOE, Chicago Board of Options Exchange, decided to roll out Monday, Wednesday. What is it? And now it's Monday, Wednesday, and Friday, right?
Yes.
Yeah, that's it. So in a way, it's actually advantageous because the premiums are cheaper and you can react to events quicker. You get it?
Yes, I do.
Right.
Thank
So
you.
when people come to me and say, hey, why am I not buying, and I'll buy the next month. I'm like, listen, I love what I do. I love forecasting, but I have no frigging idea what's going to happen next month. So why should I pay up for next month? If I can buy something for $2, why should I pay $4 for the same thing for 4 weeks out? They say, well, we know, this is a very important point for all traders to understand. And traders, they rationally say, because everyone's thinking rational, except the market is not rational. They say, well, I want to buy more time. Well, whoopee, great, get more time. But what if we crash next week? So it's like buying time doesn't matter anymore that much.
Right.
I'm not saying that everyone has to play the weekly calls or puts. What I'm saying is on things which are event driven, you want to have cheap, close to the vest. So if you do need to bail out, you don't lose too much. You get it?
Yeah.
And that's the fundamental reason why the CBOE decided to roll out. Maybe they'll roll out like every day of the week for all I know, Monday, Tuesday, Wednesday, Thursday, Friday. Maybe they'll roll one up for Saturday for people who are bored, I mean, it's pretty wild, but that's why they did. I didn't even know that since somebody pointed out. I think it was Nav, one of our traders. I'm like, what? So I called up. I went in, checked online on CBO. They said, yeah, whoopee. And then I called up Thinkorswim, and the guy's like, yeah, they just rolled out one for Monday. I'm like, great, because the only time there was a Monday one is if it was a shortened holiday or something, but they decided to bring it. But keep in mind, Seychelles, it's good because you pay less and you can flip them quicker.
Right. Thank you.
Remember one thing about options. If there was no time value, options would purely move on intrinsic value. You understand that, right? There's time decay and there is a core value. So the shorter the time frame, then the time decay, let's put it this way, the intrinsic value will move faster based on events that's happening in the market. So you can react quicker to things. You can react quicker. The longer it is, there's time decay. If nothing happens, the option basically just decays out because the time decay eats away at the premium, right?
Yes.
But in a way, it's more action orientated. Really, that's the best way you can see it. So taking a look at the VIX here, and I use the Darvas and all that because my brain doesn't work that fast, you can basically see that on a weekly basis, the looks like the VIX could hit the upper end of the Darvas, which is 26. Now that will only happen if the market goes down another 300 to 400 points or 500 points to the levels that we saw, which was 2060, right? So we are at that's roughly 90 points times 500 points. Yep. If we go, or maybe 600 points, if the market drops anywhere from 500 to 600 points, the VIX will be up here at 26. Now, will it be on a straight line thing? I wish I could tell you. I mean, there could be some stuff out there which is really like a bond bubble that, I'm not a credit guy, so I'm not seeing the internal swap spreads and stuff, right? If there is like a credit default somewhere because of some big fund blowing up, that's the biggest danger with being long right now, is that it's some stupid, greedy, like 24-year-old kid like putting in big leveraged bond funds and they're blowing up. It happens. And when a fund blows up, boom, everything just goes. So and if a couple of smaller ones blow up, VIX will go to 26 really fast. But this is a weekly chart. Now here's the good news. And that's why internals are so important. Look at what's happening to the internals on the weekly. They're getting overbought really fast. And you know what that means? That means the VIX will drop rather quickly. But they're not fully overbought yet, as we are seeing probably the 20 parameter, the green line, has not moved up to that overbought zone yet. Do you see that?
Yes.
Now that's the weekly. Let's look at the daily. I bet you the daily is way overbought. Oh boy. So look at the daily. The daily is on the top of the Darvas. So if I was a really committed bull, and I'm like, I'm really bullish about everything, right? I'm bullish about life. But the thing is, that candle's telling me that, yes, we could squeeze a little bit higher, probably fill the gap up here at 22, or maybe on the daily, at least for the short term, we're done with the selling. You see what's happening to the Darvis? It went straight to the upper end of the Darvis. And let's take a look at the 50 and the 34. They still haven't crossed. Once this 50 and the 34 crosses up like it did here, you know the market's going to come down hard, right? Because at that point on the reverse side, the market will have a negative crossover of the 50 and the 34. So we have to watch this if you'd like to really play the proxy on the market. You know what I'm saying? So that's one thing to watch. Now the daily, this by the way, I'll admit, the first time I'm seeing this, the daily, like I didn't realize was that's pretty big. Now that's a big momentum candle. You got to respect the candle. So I wouldn't be surprised if it pushes up towards 20, because generally speaking, the VIX likes to go on round numbers, right? 10, 15, well 15 is not a round number, but still it's in 15, 20. So maybe we go to 20. Now let's look at the hourly. Forget about it. I mean, I had some UVXY, wish I had more. The UVXY just went through. I mean, the VIX up 40% in one day. I mean, that's like out of control. I mean, that's really out of control. So, so that's, is it good, bad? I think it's bad, because 40% higher, that means it's got some real juice there, you know? I mean, 40% on the VIX in one day, but then somebody else might correct me and say, hey, no, that's a little bit too much and maybe it needs to come down. Maybe it will. So there's a lot of different things that are played out. There's no direct answer to it, but we have to be selective on individual stocks. I will tell you, we will get selective buyouts on companies. I'll tell you that right now, because last thing I'll tell you before we sign off is a lot of companies that have been sitting on the sidelines are now going to act to put their mergers and acquisitions plans in the works before rates move to rates move away from them, because a lot of these things are financed not only by cash but by cash borrowed or leverage, right? So you will see a flurry of quick mergers and acquisitions, which will, as before rates rise too fast, too quickly. So we just have to be, aware of that, and hopefully we'll catch some of them. Fair enough. Any other quick questions?
Hey, Frank, I got one last one just to be really quick.
Sure.
On Monsanto, you said they were playing shenanigans. Why are people playing so much with that, with the volume being up so high?
Yeah, so my feeling is, I'm looking at it very simplistically. It looks like Bayer really wants the company, because they've been after Monsanto for a while, right? Now you understand a lot of the details and stuff better than I do. But my feeling is that looking at the chart pattern too, the stock's all it's been doing is moving sideways. You know what I'm saying? So if you look at the daily chart, right, and because we tend to follow it so closely on the 15-minute and the hour, but let's look at the daily chart on Monsanto for a minute. So if you look at the daily chart on Monsanto, nothing changed. I mean, look at this. Forget this. Internals really don't matter at this point, I mean, the last time we had a sell like this, the next 2 days the stock went up. See that? So somebody might say, oh, there was a big sell volume on Friday, which, sure it was. But then there was a big sell volume on the 6th too. And then it turned around. So all I'm seeing, if you put the Darvis in motion, the Darvis box, all the stock's been doing since it hit 115 is consolidating. And if they are going to buy this company, they obviously don't want to buy the company when the stock's at 127. They'd like to buy it and have it, get there at 127. My feeling is that looking at the chart, this is a nice base, very nice base. There's an old saying in the business, the longer the base, the higher the move. So as long as we're basing within this very tight range, then getting up there shouldn't be a problem. And my final thing on keeping these calls and stuff and rolling them out is that the deal will happen. Now, there are problems with it. You know that, governments might intercede and, say, no, all these guys, all these freaking socialists, they come in and they say, oh, you can buy Monsanto, this and that. That's a different story. But I find the chart to be chart-wise and news-wise somewhat appealing. As if it breaks below the Darvis at and it's a very pinched Darvis here, very pinched, the bottleneck. If the stock breaks below, let's say 104, 103, I'm out. Because at that point, the stock's going to drop very quickly towards $9,900. I might even short it a little bit. But as long as it's staying within this range, Corey, I'm okay with it.
Do you think that Bear's been buying some of these shares themselves at this point, or no?
I don't think so. I think they're just ready to just announce a deal from nowhere. That's my feeling. You know what I'm saying? They're pretty, from what it looks like, from everything, they're pretty serious about what they're doing, you know?
Yeah, okay, thank you.
Okay, yeah. And I just like you, I just want the deal to get done. Give us 125, I don't care. Give us 120, I don't care, right? I mean, just give us anything more than $10 above where we are right now. We're good. Paras asked, you know, what do I think of Win? I don't think of Win at all. I'm just kidding. Win is a very tricky stock, but the charts are good. All right. So that's the best way I can put it. Steve Wynn knows what he's doing. Macau seems to be picking up with the revenue. As long as China is not collapsing and Chinese markets are starting to move up nicely, some people have said that the Chinese markets are entering a new bull market. You've seen the Chinese stocks, you know, what happened to them. So basically, if you look, just use pure technicals, Paras. You just put the Darvis on the daily. This is your trading range. Your trading range is 107 and 86. Stock's looking good. It broke out over the 50 and the 34. What I would like to see for a sustained uptrend, not like up 3 one day, down 3 the other day, for a sustained uptrend, I'd like to see this very flattened moving averages actually turn up, just the way it did here. Okay? Just the way it did here.
Yes.
Once it turns up, you're going to go north of 106 and hit 120 very, very quickly. Somebody says, where do I think the bias is? I think the bias is up. Even though the dailies are overbought, it doesn't matter. It's a good sign. It wants to go higher, but it needs to basically break out of this zone over 106. But one can trade the stock for 3-4 points as long as they're following the box. It's box right now, you know. It's a box, and you can trade the box all day long as long as you're doing it. You can see that. So that's it. Clean cut. All right. Now,
Thanks, man.
I just want to take a quick thing here. 1 second. So it's going to be a very interesting week. This session was important because 1 second. I'm just putting down, making a note of who was here. Okay. Because we put everything in perspective. So even if we get 200-300 point drop, I can assure you, none of you who attended this session are going to be like, oh my God, it's all over. You'll know exactly what's going on. You'll watch.
Yeah, we will make money if it big drop tomorrow.
Yes, there you go. And you will look at the internals. When I'm posting the charts, that's why this ACS is so important. Not just for you guys. It's important for me because it makes my life easier when I'm putting some technical charts out there. People can look at it and say, okay, I see where he's going with that. The problem is that when people don't do the ACS, that's when they get lost. So what I'm basically saying is let's look to see what happens tomorrow. We get a nice little drop. I'll be watching all different time frames, primarily the 1 hour, the 4 hour, and the daily. I'll be active in putting out the alerts. Let's not go crazy, and let's have a great week this week, okay?
Before you sign up, can you give a quick one on Tesla and CMG?
Yes, I'll do that. Yeah, 1 second. Tesla, I'm long. 1 second. I saw something in Tesla which caught my eye. This is the daily on Tesla. Okay, I had projected that the stock would basically come down to 187. It can still do that. It can still do that, but this is what I saw on a short, because I'm playing this short term, is before the final sell-off, 400, at the end of the day, Tesla's creating a very powerful, this is what the stock was trading at. This was the last leg of the sell-off. To me, it doesn't mean anything because everything was getting sold off at that time. So let's say the double bottom is here. This is a very powerful dragon bullish formation, multiple bottoms, which is projecting 205. So this should be the short-term tactical chart on the stock, because honestly, Tesla is a dangerous stock to short, like on a macro basis. Yes, I've shorted it, at 206, and it went there, and I took money, and then it went down more, all that stuff. But at these levels, where is this deeply oversold, specifically on, and the pattern is signifying a triple bottom. You can see here with the capitulation volume, these are capitulation volumes, very high, quite very oversold on the 1 hour, and a McClellan at -700. I mean, that's like ludicrous speed. You know what I'm saying? On Tesla's cars, right? They call it ludicrous speed. So the thing is that that's a lot. -700. Now let's see what it's doing on the daily. Now on the daily, this also you're looking at -147. The daily chart is more bearish than the hourly chart. Let's just put it this way. So I would keep it close to the vest, and any type of nice pop would sell it. The daily chart kind of can be easily drawn to say that it's going to 187. That's what you keep on hearing. But then if everybody wants that level, maybe it doesn't go there. I'm playing the hourly charts, Tim. Now, that's Tesla. Now, Chipotle on Thinkorswim. Let's see. Wow, another 700. Wow, these are like serious oversold readings. And just keep in mind that aside from the last 3 o'clock hour when everything sold off, there was no volume on CMG, because that's another thing that I watched, right? There was lots of activity that day when the stock was up 24 and we caught it. But aside from that, there really hasn't been any volume on the stock. In fact, the stock was doing nothing till, that's down a couple of bucks. On the hourly chart, the stock, I'll start from the bottom, that is seriously oversold. -700. This is creating a nice basing pattern on the stochastics. The only danger is, this is what I would do. This was the breakout level on the stock. For 1 second, there we go to the dotted line there. Okay, so as you can clearly see here, this was the breakout level on the stock, and right there, and that's exactly where we came down to on Friday on the 400-point Dow sell-off. So this level needs to hold. If the stock does not want to go higher, then you're going to be looking at 410, because that was the level that the stock basically gapped up. I doubt it. I think overall my fundamental thesis is CMG is now has a major backer. There's a lot of haters on Chipotle. I don't know the short position on Chipotle, but I don't think that I think there's quite a few shorts on Chipotle. If I draw this uptrend line, I am looking at around 415. Looking at the daily is a more constructive chart. I'll tell you. 1 second. Let me get all the drawings out. Beautiful. So on the daily, the different ways you can play it, okay? You can look at that. Some people can easily look at that and say, wow, look at this. This is a perfect double bottom, long bottoms, not like short bottoms. So this is how you draw it. You're looking at 450 to 460. Some people might say, hey, it never went over 440, so how can you say that? I said, no, the reason I can say that is because I'm looking at pattern symmetry. Pattern symmetry can make a lot of money. Does it happen in one day? No, but it doesn't take that long either. So I'm looking for around 450 to 460 to be the exit point for the stock. If somebody's thinking of it a little bit longer term, let me just show you how you can do it. All you have to do is do the daily. Okay, all you have to do, which I did do and put it on a couple of days ago before the move, is draw a Fibonacci retracement. Big stocks like this, big powerful stocks like this, always follow Fibonacci retracements. Okay, so the first Fibonacci retracement is 473. Swing traders, probably by October. Okay, 473. 50% Fibonacci retracement, which is very, very possible, is 571. Somebody says, no way it's going to go to 571. I say, don't ever say that, because I've seen stocks do stranger things. And honestly, it has broken a major you can draw this major downtrend line all the way from $775 when everyone thought the stock was going to go to 1,000. I did too. And you can draw a major line and you can clearly see that it's broken the downtrend. So short term, I'm looking for 10 to 15 points. Watch, again, it's event driven. Another guy gets sick, maybe the stock drops another $5, $6, but I think it's in a major basing pattern. Personally speaking, I think by the end of the year, the stock's going to be more than $500. Easy. In fact, probably like $600. That's my opinion by the end of the year. So that's it, guys. So listen, we'll catch up tomorrow. Thank you for attending. We covered quite a few things. I'll put this uploaded by tomorrow morning, and let's connect tomorrow morning and do the right thing, all right?
Okay, thank you, Frank. Thank you.
Anytime, Corey. Okay, God bless. Take care. Bye-bye.